So where we were now was I was showing you the monthly contribution of her endowment assurance. This was an endowment policy. And then, of course, annually, that was 120,000. And then, of course, after contributing for 15 years, she would have given this particular company 1.8 million. And of course, after now the 15 years are over, your sum assured is what you're going to get after they call it an investment. So let me just call it the investment period is over. After the investment period is over, my client for this one policy should have gotten 1.6 million. For this one, again, the total contribution after 25 years would have been 3 million. Her sum assured is 2.6. For her own contribution in the third endowment assurance policy, her contribution here would have been 3.6, but the sum assured from ICA would have been 3.2. Own contribution 4.2 million, sum assured from the company around 3.6 million. So this is the first lesson I want to give all of us in terms of when we, I think we keep saying, an endowment policy or an education policy is not necessarily like an investment per se, because what is exactly is investing? So let me just pull this up kidogo. You see, saving is capital preservation, as you can see here. It's like I have put 1.8 million. After the investment period, if I can get my same 1.8 million, what I've done is that I have saved. I have done capital preservation. Investing, on the other hand, is what we call capital multiplication. It means that I have put 1.8 million and that money will be multiplied. As you can see from the numbers of the sum assured here, the money has actually not multiplied. Now, I'm not saying that this is typical of all your insurance products. That is, in this case, today we are only discussing endowments and education policies. Okay, this is not the case for all of them, but this is the case for some of them. So the lesson number one I want to give you guys, for all the policies that you have today, please do such a calculation. It's very simple. How much are you contributing per month? Okay. How much are you contributing per year? So just multiply whatever you're doing per month times 12, and then multiply by the number of years your policy is. If your policy is 15 years, 20 years, however long, so that you can know how much you have actually given the company. Okay. Once you figure out how much you've actually given the company, compare that with the sum assured so that you can actually see whether, okay, am I getting more or less? And then you can begin to now introspect and to question. Is it making sense, guys? I need you guys to talk to me in the comment section as we continue, because I want to make sure that we are understanding, why this is important. Yeah. Now, investing is capital multiplication. Now, what is insuring? Insuring, and that is why Nyindo is here today. I'm not an expert at that, but the little that I know about insuring is that it is actually risk mitigation. There is an explanation as to why these numbers are the way they are. Nyindo will tell us why these numbers are the way they are, okay? But from where I sit as an investment advisor, I would want to now challenge this. So I was trying to do these calculations for my client, and I was trying to show her, let me now show you the difference between insurance and investing, because I think a lot of us are not able to understand the big difference between insurance and investing. So what I want to do, I want to come to my website. On my website, the Legacy Hub Kenya, we have some very good tools for you. And one of them is when you come here under resources, you can find a compound interest calculator. Now, this compound interest calculator generally is for you to just figure out, if I was to put the same amount of money in a money market fund, what would this look like? Now I want us to now compare. So this person is actually doing 10,050. So let's take, for example, if this money was not in an endowment policy and my client decided to take the same amount of money, but instead of putting it, let's say, in a policy, she decides to put it in a money market fund. Now, why a money market fund specifically? I use the money market fund because it is the lowest risk, lowest return. And it also has taxes and it has management fees. And one of the selling points was the fact that I think one of the selling points of insurance. How many of you give me a quick yes in the comment section if the selling point you were given for your education policy or your insurance policy is that it comes with tax benefits? How many of us got that as a selling point? Yeah, give it to me. Correct. So that's why I'm actually using a money market fund, because a money market fund has all that. It has taxes, but also at the same time, it also has management fees. In fact, there's 2% management fees on most money market funds. Now, let's calculate. So this is 10,050. Now, if this money was in a money market fund, it would be compounding on a monthly basis, because that's what money market funds do. So that is 10,050. I want to use let's say, I want to use like 11%. I know some money market funds are probably higher than that, but let me just use 11% return. And then this particular policy, the first one was for 15 years. So let's also make sure that the term for the same is 15 years. Of course, now money market funds compound on a monthly basis, and additional deposits. Of course, you will be doing 10,050 every every month. And then now we calculate and see in a money market fund, what would the same amount of money have gotten my client? As you can see, the final value of this investment before we remove any taxes or fees would be 4.6 million. So I want to actually take this 4.6 million and remove all the expenses. Now, the 4.6 million, I have to take out 15% withholding tax. So, of course, money market funds will charge 15% withholding tax. And then they will also charge 2% management fees. So ideally, out of this 4.6, we are going to remove 17%, because 2% is for fees and 15% is actually for withholding tax. So ideally speaking, this person will retain only 83% of this particular investment. So let's now do net of all, sorry guys, just a sec. Now let's do net of all the fees. So ideally, she would retain 83%, which is 0.83 of 4663 for 56, maybe 0.76, whatever. So that's it. Okay. So I want you guys to give me your comments about this in the comment section very, very quickly. If you've ever done this calculation for yourself, or if you knew this is something that you can do, comparing. You're like, okay, if I put it in endowment or an education policy, this is what I get at the end of the period, which is what your sum assured is what you get at the iondo kenye watakulipa. That's what they'll pay you after the investment period is over. Now, if we go for a low risk, low return money market fund that gives you 11% per annum, I've taken out taxes for 15%, and I've also taken out management fees for the same. Now, what do you guys think of this? Just please drop me any thought you might have in the comment section, because this is now what we are challenging some of us to actually do, so that you can actually begin to make some, informed decisions. And I know Mnindo will come in, and I don't want to speak as to why the numbers are. There's an explanation. By the way, ICA is not robbing you. It's not a scam, but there's an explanation as to why the money is less. Okay. There's an explanation as to why the money is less. And she's gonna be taking us through, that. Okay. So, I don't want to spend so much time, but you could always do calculations even on the other ones. Now, this one now is like for someone who was doing very little money. Now, the client that made me call Mnyendo is my second client who was doing the millions, millions. She was doing it in the millions every year. She was doing 1.2 here, 1.9 there, 1.9. You can see her own contributions. Now look at what the contributions are. For a policy, she had contributed 18 million. Her sum assured was 12 million. I hope you guys are beginning to see that this one where you're just doing 10 Gs or maybe you're doing like 120,000 every year, you do not see how impactful that money can get. But like for some of us, I know some of our Kenyans in the diaspora or some of our high net worth clients, we do some of this without even doing the numbers. You can see for each of these policies, there's only one that gave her more. Like this one, she contributed 8.4. This one, and she was getting 9.7. So she got like 1 million on top. This one, she was getting 6 million. She got 6.8. So again, we are actually going to, so you don't even want me to do the calculation here to see if she had put it in an investment, because this was sold to her as an investment. And you know, I was actually telling Nindo when I called her, I told her, my client is in tears and that has pissed me off so much. And I'd want us to actually have this conversation. So I hope I've set that foundation for you guys to begin to see how you should actually begin to compare, you know, and to look at this. Catherine anasema inaitwa mahesabu. Mahesabu ni ngumu, inaweza fanya ulie. Like you can really just, you know, cry. Mnyendo, I don't know why you're laughing at us, but like this is the reality on the ground. And that's why I wanted you to come and probably help us to, you know, to understand. Okay. So now, guys, stop panicking. You people who are saying you're already crying in the comment section, we are saying there's an explanation to this. And now I want Mnyendo, I think I'm just going to throw you in the deep end at this particular point, and then I'll hand it over to you. Could you please... Yeah. Before you do your presentation, because I had this prepared for you, I would want you to take the people listening to us through why I would contribute 1.8 million into an endowment or an education policy, and my sum assured is less, or hata kama it's not less, like the nini is the return I get after 15 years in comparison even to a very low return MMR. What is causing this discrepancy? I'd want you to take us through why.
Yes, that's a very good question, Susan, and I'm actually going to cover that during this session. So you have to remember, the moment you're contributing a premium to the insurer, first of all, let's start with the fact that this is it's a hybrid product. It's 2-in-1. Yeah, it's promising you in case of a death, disability, critical illness, depending on the policy you've taken, it will give a payout, right? And then it's also promising that at the end of the day, when you've survived the term, there is going to be a payout, right? So what is happening out of the premium that you're contributing every single month? Part of it has to go towards the actual savings, and part of it goes to the actual insurance. Just the way with insurance of a car, when you contribute, let's say the term is over and nothing happened, usually that part falls off. It's just that now they don't give all that information. It's just that what happens in the back end, right? And then the other thing is you have no control on what the insurer is investing this money in. So remember, you're paying your premium. Part of it has to go to paying commissions, fees. Yeah, it's a business. The only thing is that you don't know how much is actually going to the management fees. Because you see now with things like money market funds, it's very clear how much is going where. Right? But now you are just telling the insurer, I'm trusting you with my 10,000 shillings a month, my 50,000 shillings per month. And at the end of the day, you've told me you're giving me this money back in return, because most Kenyans don't sit down to do the numbers. So you've given them the 50,000, there's an exchange, right? So they do with that 50,000 what it is that they want to do with it. Yeah. You just know at the end of the day, when the term is over, this is what I'm expecting. If I was to pass away or get a critical illness, this is what it is that I'm expecting. So you're giving them full power to do what they want with that 50,000 of yours. Right. So that's why I said, like, I think one of the biggest issue is the lack of transparency. I don't know where exactly my money is coming in, because when you look at the numbers, the math most of the time is not mathing. Yeah. So you'll see that if I was to even just put this money in a money market fund, especially for the people who are looking at it from a returns perspective, I think the thing that pains me the most is people who take this as a as a retirement plan. Yeah. And then the other thing, you also have to remember, some of these policies, especially if someone sells you an endowment policy instead of putting money in an individual pension plan, is because they give more commission, right? So you have to ask yourself, is this person putting my best interests at heart and my family? So when it comes to the numbers, it's because most of the time the investment is in a low risk investment. You don't even know how much of the 10,000 is actually being invested, how much is actually going to insurance, and how much is going to fees. So you just know, I'm putting 10,000 in, this is what I'm getting out. You've not done the math, but they have already done it for themselves. They know, okay, for me to be able to make profit, for now, what it is that we're going to give the client at the end of the day, what it is that we're getting in return. So this is why it's also important for you as the person who's buying this to now check your numbers. Your numbers have to make sense, because you have to ask yourself, okay, I'm paying all this money, 10,000 per month, for a sum assured of 1.6 million. What can 1.6 million actually replace your income? Yeah. So even if you're looking at it from a savings perspective, 1.6 million in how many years? This is 15 years. What is 1.6 million in 15 years if you put into consideration inflation? So if you're putting in money and it's not beating inflation, you're losing out money. So I understand most people take it because they're like, oh, it's a savings plan, but in case life was to happen, I have at least, I know my family is going to be taken care of. But question is, at what cost? You see? So this is why now I know during the session, we're going to look at it even deeper, and you're going to look at examples and to see, okay, what could be an alternative, or now that I'm already in here, what do I do next? We're going to cover all of that during this session. So yeah.
Yeah.
Yes,
Wow. Thank you so much. I mean, yeah. So guys, as we are doing this, please make sure that for the guys who have your policies, I hope by now, as we've been talking, you've done your math. How many of us have done our math already? Hands up.
Nope, everyone has these documents. By the way, it will not make sense.
Yeah, please don't be in this class without your policy document. Please make sure you get your policy documents. Please do the math as we speak right now. Okay, so that even as Mnindo begins to take us through the master class for today, you are aware. For the guys who are saying, please remind us. Someone is saying the math is not mathing. That's why we are here. Okay. It's very simple. I just want you to calculate how much you're giving your insurance company at the end of the duration, whether it's a 10-year, 5-year, 15, 20-year policy, and then compare with what your policy document says is the benefit you will get at the end of it, the sum assured. Okay. Patrick, Woishe, tutaongea hiyo maneno yote. We will actually have that conversation. All right. Thank you so much, guys. I think I'm going to hand it over to Marianne. Take it away.
Thank you so much. And thank you again. So I'm really grateful to be doing this session. I know we had a YouTube video with Susan, and with that came also a lot of questions. And today we decided to do the numbers, and this is unfiltered. Yeah. And I just hope that today you've come with all the questions that you've had. And the one thing we have observed, especially when there's an issue regarding insurance in general, one of the biggest bones of contention is now life insurance policies. Because you see now what used to happen is we used to contribute this amount of money. Like it was one of those things. It was almost like a rite of passage. Yeah. The moment you get to work, there's always someone who's going to come to your office and try and sell you this. And they'll ask you, oh, uko na mtoto? Yeah. Do you have a child? Or sometimes they even catch you there outside the supermarket. Yeah. So most of the time, because you've seen maybe your mom have it or a friend has it, so you know that it's the right thing to do. And you've never really sat down to understand how it works and if it is the best solution for you. So now I'd like to get started with these classes, so that now you fully understand. We want by the time you're done here, yeah, you even know much more than an agent. So even when an agent approaches you, you know the right questions to ask, so that now you don't feel like you're played. Because I think the worst thing is when you buy a product, and especially something like life insurance, which is so long term, you buy it and you feel cheated. There's nothing as painful as that. So what we're trying to do, especially with Susan, is to give as much information as possible and also increase insurance literacy. Because we realize a lot of people don't even understand how insurance is supposed to work. Yeah. So let me just get started in at least the presentation, so that we can fully understand. And Now, as I said, I hope that you all have your questions ready. Give me a second. Let me share screen. Susan, maybe you could give me access. Let me see if I can share now. Okay, now it's okay. Let me know if you can see my screen.
We can see it. You just need to put it in presentation mode so that we can see it better. Okay, now it's okay.
Okay, perfect. So today, as mentioned, we are speaking of the truth about endowment policies in Kenya and the things that they don't tell you. So that even now, as I said, when you're moving forward, you're coming in from a place of informed, you can make an informed decision, right? From a place of knowledge. There's nothing as important as having knowledge in everything it is that you do, right? And then again, it could work for you, from some people not, but at least by the time that you're done with this webinar, you'll know if this is the right plan for you. So the webinar is for you if you've ever signed an insurance policy and later realized you did not fully understand it. Yeah. That's number one. Number two, if you've ever asked yourself, is this policy the best use of my money? But you've never really gotten a straight answer. Maybe you've been trying to search for answers. Maybe you've had a feeling that, it might not be the best plan for me, but you just don't know where to get the answers. Number three, if you have an endowment policy or you are offered one and you want to know the truth about what you really signed up for. Because you see, most of the time when the sales process is happening, majority of the time it's very high pressure. Yeah. You know how us as agents can be. We can be on your necks. We will breathe there on your necks, telling you, oh, your children. Yeah. But sometimes most of you make this decision because you want to get the agents off your back. Or you're just like, hey, okay, yes, there's my children who have been mentioned here, but I making, did I get the best product for now my situation? And then maybe you've had terms like maturity benefit, bonuses, sum assured surrender value, and secretly don't know what they really mean. So today we're going to go deeper so you fully understand. And then again, also, if you've been wondering whether to cancel, to keep or restructure your current policy, because a lot of people, especially the ones who've come to us for policy review, have realized that it's not for them, but they don't know how to best get out without losing a lot of money. Because remember, these policies most of the time are not as flexible. So you cannot just live the way you feel like living. You have come into a contract between you and the insurer. Whether you had all the information at hand or not, you signed that document, right? So it means if you try to come out of this plan early, there's going to be repercussions for your actions. But now what we try to do is to minimize the pain. Yeah. And then lastly, you want to learn how to structure your protection and investments like the wealthy do and the smart investors do. So separating and strategic, because I know I've seen some people saying, oh, put the whole amount in money market fund. But the one part people are not putting into consideration, if you've been contributing money into the money market fund and it's year 4 and you've passed away, the amount of money in the money market fund will literally just be your contributions plus the interest. But what about a payout in the case, one was to pass away? Because again, especially for the people who have young children, you have to put that into consideration. Between the age of 0 to 25, you need to make sure that your children's lives are uninterrupted no matter what. So if you put your money in an investment only without thinking about protection, you're also equally as exposed. Yeah. So let's do a small introduction. And I want this to be very clear that this is not an attack to any insurance companies or agents. This is a time it's now a session to help you make an informed decision. We are looking at the products as they are. Yeah. Again, the one thing we have realized sometimes is there could be like any industry, there's the people who do this thing for good and some not necessarily. But the other thing that I have realized, especially in our industry, is some people don't even have knowledge. What they were introduced to as agents is education and endowment policies. So all they can sell you as protection or investments or savings is education and endowment policies, because they do not also have the knowledge of what are the other products that are there that could be the best for you. Yeah. And then what we also want by the time you're done with this session is for you to move with clarity and not confusion. Okay. So let's talk about a bit about the history of why endowment policies exist, because there's one conversation we've been having with Susan is, why are these products so popular? Why are they pushed a lot? So first of all, you have to remember these were designed decades ago. A lot of these policies have not changed for the last 40 years. 20, 30 years, like whatever it is that they came up with at that time is what they're still selling today. Yeah. So they're designed decades ago where there was no widespread of easy investments like unit trust, like the money market funds. Actually, money market funds became a thing not too long ago. They've been there, but it's just that because there hasn't been a lot of people in the finance space at that time to have conversations about what are the different tools that we could put our money in to grow. So the ones that were mostly popular were these education and endowment policies, right? And then number two is they are meant to offer a safe savings vehicle. Because the other thing, a lot of people they say that, okay, I want to have like a level, some sort of disciplined savings plan. So I want to put this money, but I want to know, okay, even if life was to happen, there is still a backup. So it's a combination, of savings, but at least it's a protected savings, right? And then there's cultural reasons. We know, I don't know about your communities, but for us, we do not discuss death. Yeah? And now think about it. Discussing money is already a taboo. Now trying to discuss money and death at the same time. Yeah, you can imagine how that cocktail is. So for cultural reasons, most Kenyans and Africans are not too comfortable talking about death. So it was easier. It was a simpler product to sell because it's like, okay, it's a savings plan, but in case something was to happen, there's a backup plan. Right? So it's easier to sell that compared to like, okay, we are taking a pure life cover that can only protect during death, disability, or critical illness. And the money might not come to you. It will just go to the beneficiaries, right? So now the insurers had to come up with a plan that is also going to take care of our cultural issues, right? So let's demystifying now endowment policies. Yeah. So what is an endowment policy or an education policy? So education policy is just an endowment policy, but specifically for education purposes. So it's more or less the exact same thing. So this is not an investment product. It is an insurance product with a savings element. Yeah, this is why when you see that it's giving tax benefits, it's because at the very core, it's a long-term life insurance product. You see, investments are usually a bit flexible. You can withdraw, even if you would, it was not the time it is that you wanted to withdraw, but you can withdraw before time. It's more flexible. But you see now in life insurance products, it's like more or less like a subscription for 15 years or for 20 years. You have to pay that amount of money for you to get the benefit. You cannot just choose not to pay it. So this is now an insurance product with a savings element. So what does it do? It offers a death benefit to beneficiaries if the policyholder passes away during the term, and it pays out at maturity upon survival. Yeah. And then the idea is to offer life coverage while building up a guaranteed payout, often marketed as a way to accumulate savings for specific goals, usually with goal of education policy being for education. Right. So let's think about it. This is money I'm putting aside, not necessarily for growth. Yeah. I'm putting this money aside as a savings. Because think about it, when you're putting money aside as savings, it's like you're putting it in a pot for you to hold, not necessarily to grow. Because when you think of investment like the stock market, the bonds, you are looking at growth and multiplication of wealth. When you're putting money as a savings plan, you're putting it, the biggest goal is not growth. That's one thing you have to remember. So it's also very critical for you to understand what's the difference between savings, investing, and insurance. Yeah. So saving is just now putting money aside for a specific goal. That's why now this one, someone can say, oh, my goal is education. So I'm going to save for the next 15 years. Yeah. So the question you have to ask yourself, is it smart to save for 15 years or is it smarter to invest for 15 years? Because investing, remember, there's compound interest and the money is growing. Saving is just literally putting money aside for those 15 years. Because most of the time when you talk about savings is for like, emergency funds, because we know we want access to this money within short-term purposes. That's why we put in tools that maybe are more for capital preservation. But then now you have to ask yourself, if I'm going to look at a long period of time, 15, 20 years, does it make sense for me to save or does it make sense for me to invest? Yeah. So we'll talk about that. So when most people take these endowment policies, number one, they take it for retirement. As I said, a lot of the times it's sold as it's goal based, right? So someone is like, you just put X amount, you will receive this. So most of the time, now if someone says, okay, we want to save for retirement, they gave you this education, I mean this endowment policy, so that within the next 15 years, there's an amount of money you're going to receive as a lump sum. And then majority of the time is college tuition or high school tuition fees to fund education expenses, and then large purchases. Some people use it to save up for a home. Yeah. And then another one big reason is disciplined savings. There are people who said, for the life of me, if I'm not forced to save, I will eat all the money. Yeah. So some people use it as a way to teach themselves how to, be disciplined in savings. So let's talk about the different parts of a policy document. You could take a screenshot of this, but we'll also share the recording. So number one part, first part of a policy document is your policy schedule. Yeah. So this is a summary of cover and your details. So what exactly is in the policy schedule? So it's always important to check to just make sure that all the information is there. So there's the policy number, because every policy has a unique number. There's the policy holder's name and address, the life assured if it's you, yeah, or your spouse, the policy start date and maturity date. Now this is for endowment policies, the sum assured or the benefit amount, yeah. And then there's the premium amount and payment frequency. Just think about it as a snapshot. Like literally when I look at the schedule, I should be able to know what exactly you took. Yeah. So there's the policy term, there's the beneficiary details. And again, what type of cover is it? Is it whole life? Is it term life? Is it, critical illness? And then if there's any riders like disability, waiver of premium, accidental death, these have to be there. And then also the agent and advisor name and the codes are sometimes included. Okay. And then part two, yeah, which I feel is extremely critical. And this is the part most people don't look at. So you always just look at the schedule, but you don't look at what is the actual flesh of what I bought. Yeah, this is the real deal. So there's what maybe the insurance agent told you, and there's what is truly written as an agreement between you and the insurer. The one thing I want you all to remember, I understand that you can, trust an insurance agent, which is great, but I would challenge you to go back to the writing, yeah, to the terms and conditions. Because today, I could be working with Britam, I could be working with ICA, I could be working Prudential. Tomorrow, I've made all the money in the world and I'm out. Yeah, so you are left with yourself and the policy document. For the people who maybe have tried to cancel or to call their agents or to tell them that you want to surrender, sometimes you find that your agent even blocks you because they're not ready to answer this question. So if there's anybody who has ever tried to surrender a policy or tried to reach out to their agent to ask them questions and they never responded, or they were not as cooperative as the time it is that they were selling, please let us know in the chat. Yeah. Because that's a lot of the people who we've done the policy review, that is what has happened. And it's because now when someone is trying to sell you, it's very different from the time it is that now you're going through it and you're like, this is not what I wanted. So now in the policy term and conditions, those are all the things that are needed there. And again, very important, the moment you buy your life insurance, always ask for it immediately. There's some people who don't give the policy terms and conditions to you immediately so that they can buy time, because there's what we call a 30-day window period. Within those 30 days, if whatever the agent told you is not in line with what is written, you can actually cancel and get your money back. So sometimes people try to buy time so you don't get your policy during the 30 days and then you forget about it. You just continue contributing. Yeah. Please treat your policy document as seriously as your employment contract. I know some of you will even look for your friends to go through it for them. But for some policies, as long as 15 years, 20 years, you don't even bother to go read it. And this is sometimes a matter of life and death, even for your family, the reason why you took it in the first place. So number one, the elements of the policy term and conditions is the definitions, the benefit description. So it's more detailed, because remember, the other one was just a snapshot of what you have, but this one now is now fleshed out. So detailed explanation of the coverage, the payouts, and when the insurer pays. There's the exclusions. When is the insurer not going to pay me? Yeah. And again, like, is it now suicide, fraud? Like, everything is written down. There's the waiting periods, yeah? Like, in case, okay, so maternity is for medical insurance, but now let's say for things like critical illness with life covers with living benefits. Then there's the claims process. Okay, now you've fallen sick, you have a cancer. Is there a step-by-step process for me to understand how I'm supposed to claim this? So that now you don't have to now start reading and looking for this document when the situation has already happened. And then there's the premium payment terms. So grace period, the time period where you are still on cover even if you've not paid your premium, right? This is like a window that the insurer gives and you're still on cover. And then we have the lapse rules. At what point does this policy lapse? Yeah, it means that if you've not paid your premiums for a certain period of time, for some insurers, it's 60 days, other 30 days. So it's good to know after what period of time, if I've not paid my policy, I'm no longer on cover. We've had people who have taken policies, they've lapsed, then they've passed away, got a critical illness, and then the insurer cannot pay because your policy lapsed. So it's good to always know for how much period am I still covered, even after I've not paid. Yeah. And then there's reinstatement terms. In the case now you stopped paying for your premium, it has lapsed. How can I get back on it if I want to continue? So it's good to know. And then there's the surrender value, if applicable, the rules, if you cancel before maturity, and how much money will you receive if you'll receive it. Yeah. There's loan provisions. There's a lot. Now, these endowment education policies also have loans because remember, there is the savings part and there's the protection part. So you can actually take a loan against your savings. So you're taking a loan on your own money and actually paying interest on your own money. So this might not be the best tool because some people ask, oh, I want to take a life policy or an endowment or education policy so I can take a loan. But you have to ask yourself, what is the cost of this loan, right? Anyway. So there's alteration and changes, process of changing beneficiaries, and dispute resolution, the governing law. So you have to know what is the jurisdiction of your cover. So let's look at the endowment structure and why now a lot of you have asked, why would the amount of money be received sometimes be less, than what it is that you have put in? So usually when you, as I mentioned, when you're contributing toward a premium, right? Part of it goes towards an investment or the savings, and then a portion goes towards the actual life cover. So even for the people who are like, oh, no, I don't believe in term, part of it is still going to term. It's just that it's not according to your own rules or according to your control. Because remember, it's like it's a hybrid product. So part of it goes to the life cover so that in case of a death, critical illness or disability, it will pay out. And then part of it is invested in conservative low yield savings mechanism within the insurance company, which, as I said, you have no control over. Yeah, you literally just have to trust. So if this was your premium, let's say this was like 10,000, different insurers do it differently. As I said, they don't usually give this information on how exactly these numbers are split. So part of it goes towards an investment, part of it goes towards a life, and then the rest, management fee, commissions, and all of that. Yeah. This is why you can contribute and the returns might not be as what it is you expected because it's not fully a savings. It's not being fully put. The whole premium is not being put fully in a savings or an investment. Yeah. So that's important and critical for you to understand. And then what are the challenges of hybrid products like endowment or education policy? So the returns may not outpace inflation or the alternatives. Yeah. So you see, the reason why we put money in investment is because we also understand the value of money changes with time. Yeah. I was comparing the way a few years ago when I was in primary school, I could literally buy bread with 12 bob. Yeah. You know, those half breads. I don't know if any of you encountered that when you're growing up, but right now I came to find out that now they're 40 bob. Yeah? So this is why even now when you're making a decision now, when you're looking at the sum assured now, you have to remember that sum assured now, the value will not be the same in the next 10 to 15 years because of inflation. So if this product, if you're putting money in a product that is not outpacing inflation, it means you're playing yourself. Like literally, it might look like you're saving, but you're actually eating from yourself. Yeah. Number two, fixed premium, the premiums are fixed and limited funds, and then there's limited fund access that reduces flexibility. Again, you cannot just decide, because you remember it's a hybrid product, so you cannot just decide, oh, now I want my savings part. It's 2 in 1. So it means that if you, let's say, for example, it's been less than 2 years and you realize the policy is not making sense, you're going to lose everything. It's not like then they're going to say, oh, give me my savings part and then you can stay with the insurance aspect. It doesn't work like that, yeah, because they've been merged together. And then there's the high fees and commission, which diminish overall returns, yeah. So that means it equals to limited policy growth. And then the one thing you also have to remember is not all policies are built the same. Others have a better return, more or less, yeah, compared to others. The others which I see and I'm like, I don't even know how these are even legal. So it's important for you to always go through it and check. So even if you're to buy any of these policies because you're like, okay, I want it for discipline purposes, at least pick the best one in the market, yeah, because there's also levels to it. There are others which are for tiers, and we're going to look into it shortly. So I want us also to understand the terms. So even now when someone is speaking sum assured, guaranteed benefit, non-guaranteed benefit, you understand what we mean. So sum assured is the life cover amount. Yeah, what is the actual level of protection, right? And then there's the guaranteed and non-guaranteed benefits. So the guaranteed benefit is what you are actually promised that you're going to receive at the date of maturity. Non-guaranteed could be now based on bonuses which could be declared or not. So what could be a promise and projection? A lot of you work with projections which could happen or not. So it's important to know at the bare minimum, what am I promised? So even with the example Susan showed, that's most of the time the bare minimum, at least what is promised. So sometimes there could also be bonuses. But again, usually in the policy document, they say they are not assured. So I like to work like, then this thing is not assured. Like at least at the bare minimum, this is what I'm expecting to receive at the end of the day. And then we have what we call reversionary bonuses. So these are annual declared bonuses, small and subject to change. Yeah. And then we have terminal bonuses, which are only paid at maturity. So the reversionary bonuses are added every year. So for the people who have endowment policies which have reversionary bonuses, you can just see that they actually add these bonuses to your policy now, the statement, right? Terminal is only paid out maturity and it's also not guaranteed. And then we have surrender value. Because as I'd mentioned, this policy has an aspect of savings. Yeah. So that means that there's what we call a surrender value. This is the accessible amount if you cancel before maturity. So most of the, most of the people lose like about 50 to 70% when they exit within the first 5 to 7 years. So there's some insurers who actually show you the table of surrender. Yeah, in the case now you're to pull out, this is what you receive. And others will tell you that at that point it is that you want to pull out. They will not put it in a table anywhere. They're like, okay, this is the time that you say you want to pull out. We are going to give you 40% of what it is that you've put in. Because again, remember, you made this contract with the insurer. So even for them, they're telling you, we were to do this thing together for 15 years. Yeah. So now you're stopping here at year 4. You have to feel it. Yeah. So again, that's how another thing to look at. So when you're making decisions for long-term products like life insurance, you need to know, and you've covered all your bases. You need to know what are the repercussions of if this thing did not work out. Yeah. And then we have what we call paid up value. So this is the reduced benefit if you stop paying premium. So for a policy that has gotten surrender value, let's say, for example, it's been 3 years, some policies are 2 years. And now you're like, okay, now it started accumulating what you call the surrender value or the cash value, right? Because before 3 years, when you cancel the policy, you don't even get any money back. But after 3 years, there's what we call a cash value that has accumulated. So if you'd say that this policy is not making sense, I want to stop contributing. And then the amount of money is the value obviously of the policy is going to be reduced, and the insurer will calculate based on what it is that you have already put in. So let's say, for example, you took out a 3 million shilling policy, and then in year 5, you're like, this thing is not making sense. So you stop. So what the insurer is going to look at is all the premiums you've contributed over the period of time. against how long it is that you're supposed to contribute. And then now they're going to calculate for you a new sum assured. So what happens is that plan will remain there. You cannot pull out that money. So surrendering is you're pulling the money out completely. Paid up means you are just leaving it there. You stop contributing, and then you'll receive this money at maturity or upon death, whichever comes first. Yeah? So that's what happens with a paid up. With surrender, you're pulling out the money completely. That's when now I believe you lose the most money. Paid up, you stop contributing. The money just chills there until maturity. Yeah. So again, usually when we are doing our evaluations, it's important to know, is it better to surrender or is it better for us to convert it to a paid up? Sometimes people opt to surrender and rather even put that in a different investment tool so that they can catch up. Yeah. So depending on a case-to-case basis, we'll see what's best for you. And then there's the premium holiday. So what happens if you stop paying fees? I mean, the premiums. So the fees, lapses, or automatic policy loans. So what a lot of policies also have what we call an automatic policy loan. So let's say it's been a period of time where you've already accumulated surrender value, and you've stopped paying. So if you stop paying the premiums and you've not told the insurer that you've stopped paying the premiums, they're going to go to your surrender value and give you a loan by force, yeah, so that it can pay your premiums. Yeah. So what happens is if there's a surrender value, let's say you've accumulated a surrender value of 100,000 and you've stopped paying the premium, the insurer will now take a loan on your behalf. And usually this is something you've already signed for. It's not like they will come and ask you. It's automatic. Yeah. So what they do is they take they take a policy loan against your surrender value, the cash value that has been accumulated, so it can continue paying itself. So, and then this is an amount of money you have to pay the insurer back, or when the time has come for you to be paid the amount of money at maturity, it means that you'll be paid minus the loan. Yeah. And then there's policy loans, as I'd mentioned. There are people who you can borrow against your own money with interest. So first of all, a lot of plans actually charge you to take the loan. There's an initial fee to take the loan, and then you have to pay interest also on the loan. Yeah, so that's another thing to put into consideration. This is why it's good to know, based on what my goal is, what is the best tool for this. Maybe even a SACCO could have been better for taking a loan compared to a policy. So it's going to be a very expensive loan at the end of the day. So it's good to evaluate all the different tools and see what makes sense. So let's look at some of these definitions, and then what it actually means and the hidden impacts. So sum assured is the minimum guaranteed payout. So usually for education and endowment policies are often low for the premium paid. You'll see now an example when I share it. Like when you compare, if you're to take, say, a pure life policy versus, an endowment policy. And as I said, it all depends on what is your goal. Why did you take the plan in the first place? Then there's maturity value, because sometimes the maturity value could be different from the sum assured. So depending on how it has been structured, the insurer could be like, okay, the sum assured is this, but the maturity value could be now the sum assured maybe 50% in year one, 50%. So they're going to add all those numbers, and then that is what you're going to expect. Yeah. So it's good to also know what is my sum assured, and is the sum assured equal to maturity value. So for some policies, it's exactly the same number. For some, it's different. So maturity value is the actual amount of money that's paid out at the end of the term. It's not guaranteed unless stated. Yeah. So this is what also is included in the bonuses. And then there's the bonuses or diversionary bonuses. So these are non-guaranteed profit sharing component. So remember, this is what if the insurer has made money, they can share with you their profit. So it can be very small, and it's dependent on the company, right? And then we have the surrender value, what you get if you cancel early, which is usually less than the premiums paid. Yeah. So as I said, if you've ever tried to surrender, you can let us know in the chat box, and what was the number against what it is that you actually put in. You will feel like you are played most of the time. Very few insurers have seen that after a certain period of time, you could at least get your money back, like exactly the amount of money you've put in, but a lot, not necessarily so. And then, as I said, paid up value is the reduced benefit if you stop paying premiums. So it's a severely reduced cover. And then again, if the money is just chilling there, it's not even growing with interest rate. It's literally just money just lying down there until maturity or a death happens. So as I said, that's why it's good to now evaluate before you decide what is the best way out. Is it paid up or to surrender? And then we have a policy loan. This is borrowing your own money with interest. So there's a risk of policy lapse if it's not been repaid. So let's say, for example, you've used all the, because remember that some of these loans you can either take yourself, or sometimes if it's an automatic loan to pay your premium. So if it ends, the policy could just lapse. Yeah, you're no longer on cover. So I want us to look at common endowment myths. So there is the double benefit myth when people are looking at it. Oh, at least I have it as a saving, but just also in case it's also a protection. So this is the analogy I like to use. Let's say you want to build a table. And to build a table, you need a saw and a hammer. If I was to give you a tool which is a saw and at the same time a hammer, will you feel safe? So yes, it says, oh, it's convenient because it's on this side, it's a saw, on this side, it's a hammer. There's also chances of, yes, it might look convenient, but at the end of the day, it might hurt you. So it's good, as I said, to always evaluate and see, yes, I'm paying it because it's convenient, but is it serving my purpose? It's so important, even when in insurance, in investing, in saving, let it be goal-based protection planning, goal-based investment planning, goal-based savings. Yeah. And then there's guaranteed returns misunderstanding. Yeah. So sometimes, most of the time now, again, another selling point for a lot of endowment policies, the guaranteed returns. But again, the returns are guaranteed, but if we look at it against inflation, you've still lost money. Yeah. And then there's the fact that it's missold as investment plans. Yeah. Again, a life insurance policy is not an investment tool. It's a savings tool. Just think about it as a savings. You're literally just putting money aside. This is not necessarily for growth. Yeah. So, we want to look at what is the alternative. So we've spoken about an endowment policy being a hybrid product, a two-in-one. So if you're to transition to separate insurance and savings, how does that look like? So an alternative to endowment policy is now separating the protection and growth, because you cannot do one without the other. Yes, as I'd mentioned, you can focus on growth and be like, I'm going to put my money in my money market. But if you're to die or get a critical illness in year 5, the money that has been accumulated there is up to that point in time. Yeah, plus the interest, which might not be enough to replace your income. Yeah, so investment is good for growth, but you cannot have a full plan if you also don't think about life insurance. Life insurance is still important, but you have to ask, am I getting the right life insurance plan? So investment, remember, focuses on growth, and the growing of wealth through strategic opportunities. And then life insurance provides financial protection against unforeseen circumstances. So think about it. All of them have to run parallel. So yes, I'm growing money, but there's sometimes someone could die in year 1, could die in year 10, or get us an illness. So I just want to know, okay, God forbid someone passed away in year 1. There's a tool that can come in and replace that income. Just think about it. Yes, there's a pot, but what can come in and fill that pot? Because if you've only contributed up to year 1 or year 5, that pot is still empty, and it will not help your children reach the goal that you wanted, for them. So you have to ask yourself, okay, if I was to exit this floor, or this stage called Earth before my children, I've grown this wealth to the extent that I wanted, is there a plan to make sure that this pot is still going to remain full? So the alternative is separating. So transitioning to separate insurance and savings, or investing. So first of all, you have to evaluate your current policies. You have to be real with yourself. I know a lot of us are avoidants for one reason or another, but this is not the place and time to be avoidant, because you could be carrying the wrong plan. And again, with time, it's even going to be worse if you're trying to leave even later. I saw someone giving a very good example and an interesting analogy. It's like when you get into a train and now you realize that you passed your spot where it is that you're supposed to stop. So because now if you continue being in the train, it's going to be more expensive the further along you go. So it's good, like if you've recognized I don't have the right thing to stop, at that point immediately. It's good to, first of all, be real with yourself and be like, okay, this is not making sense. Let me stop here before I lose even so much more. Because the one thing I know is what we call the sunken cost fallacy, because we've put in money for such a long period of time. It feels so painful to maybe lose that amount of money. So, first of all, it's important now to take care of the basics, setting up a protection plan. Because again, guys, nobody knows at what point this exit could happen, yeah, or a critical illness could happen. So we need to make sure that we have already even protected whatever it is we are about to grow. So think about the protection plan already there. So whether there's a critical illness or a death here or here, there's this solid plan that is going to come through, yeah. So setting up a pure life cover for protection. And then next, open a dedicated investment account. Yeah, so it's now up to you, and also again your appetite, your risk appetite, to know, and then you'll know what would be best based on my goals. So for short term, let's say for now, emergencies or short-term planning for people like us who have children in school who are going every 3 months, I can be like, okay, let me consider a high yield savings account, like a money market fund for immediate needs, because every 3 months I need to make sure that there's money for my children's school fees. But then now for long-term growth, you could consider now investments like bonds, ETFs, mutual funds, unit trusts, yeah, for growth purposes. So here you're willing to take a higher risk for a possible higher return. But if you want to remain safe, you can still stay with your money market funds. Or we are going to discuss how you could use a trust fund instead. Yeah, to just make sure, again, one of the reasons why we also take these policies is to make sure that it doesn't go through the courts. You see, education and endowment policies don't go through courts because they are life insurance products. But again, if you were to take a money market fund and your biggest goal was to save for your kids' education and you were to pass away, these money market funds might have to go through the courts, and it will be the purpose of why you are contributing in the first place. Yeah, so we'll show you how to structure the life insurance and trust fund together to make sure you have a holistic plan. And then after that, it's ongoing monitoring and flexibility. And remember, because you have separated your protection and your investment, you can keep on checking how the investment is going, and you can make changes accordingly, and contributions are flexible. The most important thing here to note is you have to be disciplined, because with now this alternative plan, you can actually have access to investments. So you have to be disciplined enough to know that I'm not even saving for my children's education, I will not be touching. Yeah. Because the one thing that for sure you cannot just pull out at any time is a life cover. Yeah. That one you cannot, like that one, think about it, as I said, a sort of long-term subscription fee. Yeah. To just make sure that protection has been taken care of. But now when it comes to the investments, because of the flexibility of this structure, there is also access. Yeah. So that it's up to you to work on your discipline, right? So why separate is better now, in my opinion, and how we've worked with a lot of our clients, because again, there's different school of thought. So if education or endowment policies work for you, then well and good, but it's also good to know why I believe separating is better. I personally separate mine. I have really tried, and to me, if the math is not mathing, I'm not gonna put my money in it. It's my hard-earned money. Yeah, I'm even here, like having this conversation, teaching, and I want to make sure that my children and my family get the best. So I personally like to use a pure risk life insurance to minimize the cost and maximize the benefits. You'll see what I mean by that. And then with investment, I like to see growth. I literally like to see my numbers going up. And for me to save for an extended period of time, like 15 years, makes no sense to me, because if you're going to tell me that I'm not going to access my money and you're locking it for 15 years, you better give me an out of this world type of return. For you to compensate me for the time I cannot have access to that money. Especially for people like us who are in business, we always believe we can get that money and even put it in a deal and maybe turn it over. Yeah. But now for you, if you're going to tell me I'm going to lock my money for 15 years and this is a savings or investment, the return better be making sense. So I've not found something that makes sense to me. This is why we wanted to have this conversation for people who are looking for an alternative. Yeah. Because we all have a different, and different structures work for different people. So life insurance, the endowment policies, as you've seen, it has a low sum assured. So it means in the case one was to pass away, what the family actually gets is not that much compared to if it was a pure term life or a whole life insurance. So when it comes to protection, an alternative could be now having a whole life cover. So from the investment perspective, there's poor and opaque returns. We are not sure what even insurers are actually investing this thing in, and what were the returns that they got and how much they're actually giving us. So for alternative, you could use now the money market funds, bonds, mutual funds that actually grow, or trust funds. Yeah. And then there's flexibility. Endowment policies, funds are locked in for years. So even your investment part is attached to the life cover. So you cannot even just pull it out the way you feel like. That's why there's now the surrender value paid up policy. Even when you want to stop before maturity, you cannot have access even to your savings. Yeah. And so with the alternative structure, you have full control over your savings. All you just say is it's important to be disciplined. So this is why you have to do a self-analysis to know if this plan is good for you. So this plan is really good for people who are serious investors, people who are disciplined. I know that I'm disciplined. If it's my children's money, I will not touch it. And how it is that I've planned myself, I have an emergency fund in case I need to touch money. So anything to do with my kids' education, I will not touch it. So I made sure that I have an emergency fund, and then my kids' fund is my kids' funds. Yeah. Anytime I even touch that money, or think about touching that money, I feel like I've stolen from their future. So to me, that's enough discipline. Yeah. That's how I look at it. I cannot eat my children's future. And then liquidity, obviously for endowment policies, is poor. There's no liquidity. And then here it has immediate access to investments. Yeah. So I want us to look at a case study. I wanted us to compare apples to apples for a specific insurer, what their endowment policy looks like, and if we were to separate their endowment, the same insurer, if we were to get a separate product for now the pure life cover and an investment, right? So I want us to look at this endowment policy. Yeah. This is actually one of the better ones in the market, I should say, because as I mentioned before, the ones I've seen are for tiers. And I feel like they should be illegal, in my opinion. Yeah. Because I feel like they were created maybe 30 years ago and they've never been changed. Because, a lot of clients don't make too much noise. Yeah. And sometimes because of lack of knowledge, and you do not complain, some of these products will never be changed. Yeah. And it's not changing according to the times. Because remember, at that time, there was very limited knowledge on investments compared to now. Our parents did not grow with the internet like we do. So for them, if they are making these decisions and they're just buying, it's because they did it with all the knowledge they knew at that time. At this time, the reason why a lot of us are asking so many questions is because now we have knowledge. We have money market funds. We know how bonds work. We know how the stock market works. So when we look at it side by side with an endowment policy, we're like, the math is not mathing, especially if we're looking at it from a growth standpoint, right? So let's look at this one. This is a policy where someone is paying about 30,000, let's say 29,666. And then the sum assured they're being offered is about 4.1 million. Yeah. And then the benefit before the bonuses, which is to the full amount of money which they're going to receive at maturity, is the what do you call it, 10 million, right? And then there's the projected bonuses. So remember, as I'd mentioned, what is the sum assured could be different from the maturity amount. That's why it's important to know. A lot of insurers, the sum assured is exactly the same as the maturity amount, but the sum which it's different. That's why I said like this one is at least one of the better policies that I've seen. Yeah. So you can see this person is contributing for 20 years. And then, so upon maturity, the amount of money that will be paid out is 12.6 million. Yeah. And then that means that's the 10 million benefit plus the projected bonuses. So they could be paid, they could not, because again, they're reversionary bonuses. So it depends on whether the insurer is going to declare this bonus that year, right? So these ones are projections. So remember, there's what is guaranteed, and then there's the bonuses. So what is guaranteed to be paid is the 10 million. But now the bonuses are two. It could be paid, it could not, yeah? And then now we have in the case of a death. So what a sum assured means is in case one was to pass away, what is paid immediately. And also remember, different insurers work differently. So you have to know the terms and conditions for your policy. So for this particular policy, if someone was to die today, for this about 30,000, the family will receive 4 million. And then at maturity, the family will receive 10 million. So let's say, for example, someone had taken this policy and then they died in year 2, the family will get the 4 million. And then after the 20 years, that's when the family receives the 10 million. And then in case of a critical illness, same thing. It's now 2 million instead. And then upon maturity, the family receives 10 million. And then usually accidental, the benefit is double. So double of the 4.1. So that comes to 8.33. So again, it's good to actually, when you're reading, when you have your policy, just put it here in this type of format so you can have a clear picture of what you actually have. Yeah. So here, in case someone was to pass away due to an accidental death, the payout is like about 18 million, right? So I wanted us to now compare apples for apples. So remember, they're paying about the 29,666, about 30K. So what would happen if, and this person, the example we gave was actually a real life example of this lady, actually she's called Anne. Yeah, who is a non-smoker, term for 20 years. The reason was education. So they were looking into now planning for the child's university education. So she was getting married, and when she was doing her mathematics, yeah, if she was now to give birth within maybe the first year or two of marriage, within the 20 years, the child, the firstborn should be going to school. So let's now separate the two and we look at how that looks like. So the sum assured insurance premium of this policy, they will only pay 8,000 shilling for a 10 million shilling policy. Right. So what that means is, remember, we are separating the two. They're taking an insurance, pure risk by itself, and then a trust fund. We're going to speak a bit more about it as now the education plan. So how they've structured it, because they wanted something similar to an education or endowment policy. So they wanted that in case they were to pass away, the funds from the life insurance proceeds are going to go into the trust fund, and this money in the pot is going to be used to take care of the kids' education. So let's look at it. So remember, we're working with this 29,666. So we're looking here. Insurance premium is going to be the 8,181. And I'll show you the breakdown of how much actually goes to the sum assured in case of a critical illness or disability. Yeah. And then now let's look at the investment contribution. So it will be the remaining 21,000. So if we were to contribute this 21,000 per year, that's times 12, that's 257 at 12% per annum. Actually, last month, the amount declared for the trust fund was about 15%, which is actually pretty good. So at least you know that it's the either money market levels or sometimes even better. Yeah, they've actually upgraded the sorts of return they're giving. So still, yes, preservation of capital, but the return is better. So here it's compound interest. And then for 20 years, they'll receive 21 million. Yeah. Compared to the 12 million here. And then also, again, remember, Paul, like, oh, what if this person was to pass away? So if they were to pass away sometime during their contribution, this 10 million is going to be paid up into this pot. So either way, it will continue. So remember, the life insurance, just because it's what we call an assurance product, it's what is going to for sure ensure that in the case of a death, critical illness, or disability, there is still a plan for the family. And then let's look at the importance of the trust fund for education planning in this situation. So there's protection of misuse. So you see, even with the endowment policy, when the amount of money is paid, it's paid as a lump sum. Yeah. But now with trust fund, there's the protection of the misuse, because that means if you put instructions on how the payment should be done, whoever it is you've chosen as guardian does not receive it as a lump sum. And then there's control, obviously, and flexibility. There's growth potential, because you've seen it grows with compound interest. There's financial security and peace of mind. Yeah. And then again, avoidance of probate. There's no point of putting money in an investment if life was to happen, your family can't access it, or they have to go through the courts and jump hoops and look for lawyers to get access to your money. So the amount of money that's put in a trust fund is assured immediate access. And then there's inheritance protection. Yeah. Against, sometimes relatives, sometimes people who come, creditors. So any amount of money that's actually put in a trust fund cannot be touched by creditors. Yeah. That's another thing to note. So I wanted us to look at this whole life cover, because you remember I said it's 8,181. So there's the 10 million. And then there's also the whole life has projected bonuses. This is now if it was 20 years, but if someone lives longer, the bonuses still continue being projected. Yes, there's waiver of premium. Yes. In the case now, one was to get a critical illness. So critical illness, you see, it's even paying more. It's paying 5 million compared to the other one, which is paying 2 million. Yeah. And this one, in the case of an accidental death or disability, there's an extra 10 million. So if this person was to die due to an accident, what will be paid to the family is the 10 million plus 10 million, which is 20 million in total for 8,000 shillings. And remember, the other one has to pay almost 30,000, 29,666. Here for only 8,000, you're getting much bigger protection. Yeah. So I understand, yes, you do not like to think, oh, maybe I might never receive this money, but what is the point of protection? And either way, as I said, with you putting money in some of these plans, the insurer is allocating it for you. So why not take the power in your own hands and say, yes, this is the money I have. This I'll allocate towards my pure life, so that now in your mind, you put it as a subscription for protection. It's a subscription for protection. I need to pay this so that I have the protection for my family, whichever stage. Because remember, with an insurance, it doesn't matter if someone exits or get a critical illness in year 1 or year 10. This amount of money has to be paid out. This is what an investment cannot do for you. That's why they both have to work at the same time. Yeah. So that is now how that looks like. So whole life insurance, it protects for life. So the one other challenge with endowment policies is when the moment the term is over, let's say you took an endowment policy for 15 years, and this happened to one of our clients. They're taking endowment policies for their kids, and then the endowment policies matured. But one thing people never think about is the level of exposure when these policies are over. They've matured. What will continue protecting you after? Yeah. So in the case of this client, they had taken for their children, and then it matured. They used the money to pay part of the children's education. And then she got a cancer a few years after. So because the policies had matured, they had no protection. So literally, she had all the investments that she has put aside. She literally had to go back into her pocket to now take care of now the situation. So it also offers a death benefit to beneficiaries when the policyholder passes away, and it also has living benefits in case of a critical illness or accidental disability. So it can be used for short protection, long-term inheritance planning, estate equalization, transfer. So at least during the period of time that you're taking care of your kids' education, we have a backup plan in case life was to happen. But later on, because we're all going to exit this earth one day, it will serve as their inheritance. Yeah. So as I'd mentioned, especially when you have children below the age of 25, this is the season where they're highly dependent on you. Yeah, there's no way of going around it. You have to have a protection plan. Yeah. So after 25, if you've raised your kids right and everything has gone well, they can be able to fend for themselves. So even any amount of money they receive there is more or less like an extra. So we had spoken about now the whole life covers as a way of pure protection. And then let's talk about the trust fund account. So the life insurance creates the money in case now a parent was to exit. Yeah. But what happens once the money is paid out? Yeah. So let's say now this 10 million shillings has been paid out to whoever it is you've picked as guardian. Without a clear plan, that money can disappear, be fought over, or wasted in a few years. So we had a situation where I know someone who had left policy for their kids, and then they passed away. They had chosen their sister as a guardian. And the sister was a businesswoman. Like, she literally used the amount of money for her business. Because remember, when someone passes away, this money goes directly into their bank account. Even if, yes, it's on behalf of the kids. So it's literally you hoping that whoever it is that you've chosen as guardian, and if you are to exit this earth before your children hit 18, they will do with that money the way you wanted it to be done. So they did start a business, and the money that was eventually left for the children is very little to non-existent. Again, and then another thing you have to remember when also thinking about setting up a trust fund, yes, you could trust your guardian, but sometimes you don't know who it is that are around them, whether it's their friends or even their spouse, or if maybe they could go through a divorce with their spouse, and then the money it is that you've left as inheritance of your kids is part of their estate, because there's no proper boundary between what was my kids and what was hers. So you have to be very careful in how you're living this. So that's why structure is important. So this is where trust fund accounts and cash management accounts come in. It's a simple way of managing cash assets for those who you care about. Yeah, because a lot of people, when it comes to planning for their kids' education, they do use money market funds. But I always tell people look, money market funds are good, but now when you're looking at it from a protection perspective, if a parent was to exit, money market funds could go through the courts. So the access might not be there. So fund is held in a secure investment kitty, which preserves capital. Yeah, return is usually between 10 to 12%, but the last month it actually went so much higher. So it works literally just like a money market fund because that's the actual underlying investment. So the one extra additional value is the legal protection and the fact that you can actually leave instructions on what you want to do. So a lot of the clients that we have left an instructions instead of money to be paid, to be touched by the guardians. If it's education, the money is paid directly to the school. And the contribution is flexible. Minimum amount to get started is 5,000, and this is credited into the account, so it grows. So users of simple trust fund is startup capital, education fund, house, down payment. Literally, you can use it for anything. Yeah, it's up to you. So how to fund the trust fund? So there's the regular contribution, just the way you contribute towards a money market fund, the money grows with compound interest. So there's life insurance proceeds, both personal and group. So you make the trust fund the beneficiary. So think about it as a central pot. So in case one was to pass away, get incapacitation, the money goes into this pot, and the pot is held secure and nobody can touch it. But according to how you've left instructions. So I like to say life insurance and a trust fund is like a financial clone of yourself. So you've left instructions. So yes, a life insurance is a good place to start, but paying out a lump sum and there's no structure is almost as good as not having a life cover if this money is not going to be used for what you intended it for. So yeah. And then pension plan proceeds. Yeah. And you also still make the trust fund the beneficiary. So these are projections. You can see here 5,000 per month for 20 years. It will come to 4.9 million. And then this person who's contribute 25,000 for 12 years. Yeah, that's about 24 million, which is a good amount, especially when you're looking at it from a returns perspective. So application process of trust fund is, it's so easy to set up. You just fill in an application form. You need to send your requirements, which is your ID, KRA PIN, the guardian's ID and KRA PIN, the birth certificate of the beneficiary, if it's your child and under the age of 18, and if they're over the age of 18, an ID, yeah, proof of payment, and then grant letter. So grant letter is just a summary of everything it is that you have put in the application from your instructions, yeah. And then the trust fund account is open usually within 5 to 7 working days, and then you can update your life cover and pension beneficiary to trust fund. So the life insurance benefits, we already know there's the tax relief and tax-free proceeds. So it reduces the taxable income, enhancing financial savings. So just the way with endowment policies, you can receive the tax relief, also with pure risk products, same thing. And then whatever is paid out is tax-free, yeah, the benefits. So as I'd said, the benefits of actually the combination of what it is that we plan is there's the no probate process, so no courts involved, no judges, quick payout, tax-free payout, which is really good, no taxes, reduces family stress. So because now there's structure and ensures continuity. That means providing stability, allowing families to now focus on what's important. So now I want us to look at real life examples of policies, right? But before that, I think it will be good for us to look at whatever questions that maybe have been raised. And then now we can look into the actual numbers. So I don't know, Susan, you can let me know if there's any questions that have been raised so far.
Quite
And
a
we can be
number. Quite a number. So maybe let me pick. I think we could answer the ones that we have in the Q&A box. And then maybe we can continue to look at the numbers, right? Okay. Let me pick the first one. So I'll just be asking, I've seen quite a lot that are similar. So actually also, guys, when you go to the Q&A box, just as a comment for the future questions that will be asked, if you see someone who has asked a question that you you already want to ask, instead of typing it again, just like it, like vote on it or like it so that we know, like many people are also asking that question, so that also we don't repeat the same questions over and over again. Yeah. So there was someone who asked what is an endowment policy and what is the difference between an endowment policy and a life assurance.
Okay. So remember, an endowment policy is a type of life insurance product. So what a life insurance product does is it gives a payout in the case of a death, critical illness, or disability. But then now we have products like endowment policies, which have also extended and added savings element towards it. So an endowment policy is actually a type of life insurance cover. So maybe what you could be asking is the difference between an endowment policy and a pure risk cover is an endowment policy has the combination of the like pure and savings component, and a pure life cover has no investment component. That's why you can see it's so affordable for the type of cover. So this is why we usually look at like pure risk cover as a way of minimizing the cost and maximizing the benefit, because if you're to get the exact same benefit, you have to pay sometimes even 10 times more to get the exact same sum assured you wanted.
Yeah, what is the difference between life insurance and life assurance? Is there a difference?
It's the
It's
same
the
thing.
same. Okay, sawa. The second one was, is it possible to convert the life policy into into a different investment like a pension? At least by now, guys, we know no, you can't do
Those
that.
are two different products. So you cannot, because you see now sometimes what happens is when someone has found out that the product is wrong, now maybe they will wish to convert it. But those are two very different products. You cannot do the conversion. So sometimes I think in such situations, sometimes someone maybe was missold and they wanted a retirement plan. Someone sold them an endowment policy instead of actually giving them a pension that grows with compound interest. So now they're looking into a way of converting, but insurers do not let that happen. Those are two different products. Life insurance is very different from how pension works, even on a principal level.
Yeah. Awesome. Someone else also asked, can a life insurance also be referred to as an endowment plan because it has a time limit? I think Nyindo already answered that. An endowment plan is a type of life insurance that has a savings element attached to it. Now, I have several people who have asked about a paid up policy. Maybe you can answer because I know I've seen people in the comment section saying, oh, mine, I just decided to quit it and convert it into a paid up policy. So I think that's what caused people to begin to ask exactly what is a paid up policy, Nindo.
Okay, so a paid up plan, that's why I even put it like as part of now the definitions. So when you convert your plan, your life insurance to a paid up policy, that means that you've stopped paying the premiums, right? And then the sum assured is reduced based on the time period you've actually contributed. So let's say you had taken a 3 million shilling policy, but you stopped contributing this at year 3. So it means obviously you are not going to receive the 3 million because you did not go the whole 15 years. So what the insurer will do is that they'll recalculate it and give you a new sum assured, which you're still going to receive. You'll stop years contributing, and then you'll still receive this amount of money at maturity or death, whichever happens first. So that means instead of now the way we had mentioned surrendering, you're pulling that money out. Paid up, you're leaving it back in. It's still staying with the insurance, just that you don't continue paying the premiums moving forward, but the cover it's still there. The thing that drops off when you convert it to paid up policy, so if you had critical illness protection and disability protection, those they drop off.
Okay. I think as a follow-up to that, someone was asking, how long can I get paid out? Let's say like the paid up policy. I think you get it at the end. You still have to wait for the 15 years to end for them to pay you, right?
Exactly. So it's not really growing.
Okay. Oh, it stops growing.
Yeah.
Okay. All right. Gina was asking, what is the best alternative? How do I protect my loved ones if I signed up for a policy in order to shield them, but also I'm clearly losing money? I think that's what that is what Mnindo was just trying to begin to explain to us, that we have the option of, the combination of a proper pure risk like the life insurance plus the trust fund. I think at this particular point, Mnindo, if you allow me to also add that it is important for you to also think about the aspect of investing. When we started, for the guys maybe who are not here, I demonstrated, like, for example, taking up like an investment, like a pure investment. I think one of the things that Mnindo and I are constantly learning in, because we kind of like tend to have the same profile of clients, and we kind of like tend to, so I handle the investment aspect of it, she handles the protection aspect of it. One of the things you will realize is the moment you try to combine those two into one product, what will happen to you is that you're going to get the raw end of the stick on both ends. What maybe you're realizing with these endowments and education policies is that they have tried to combine protection and growth, or protection and investing, into one product. And that is where you guys are seeing this discrepancy in terms of like the return and whatnot. So for me, one of the best lessons I learned when I started, especially even after I became a mom, and Mnindo helped me out with this, is to know how to separate those two. There are aspects that will require protection. I think every time I think about protection, I think of when life happens, because life will happen. And the unfortunate thing about life happening is that it doesn't give you notice or a warning. It just happens, So because we are not in control of that, we get this protection aspect of it that so I think one of the things that I hope you guys are beginning to see is that insurance is not a bad thing. Insurance is not the problem here. It is the kind of insurance policies that we are getting that needs to start to change, and we need to begin to understand the role of insurance in our planning. Okay, of course, if you're worried about your child, if you're worried about, what if I die before they're 18, etc., it is good that you're, having this conversation now. Now, something that I would like to add, when you think education, I want you to think cash flow. Okay.
Mhm.
I want you to think cash flow. And let me tell you why this is important. It's because for each of your children, if you have one, you're going to be paying school fees for at least 18 years every 3 to 4 months. Every time, that is every 3 to 4 months, that is one child. So baby number 2 comes in, now you're looking at maybe 24 years. Baby number 3 comes in a few 4-5 years later, you are looking at even up to 30 years. And this is what has happened to our parents. Their entire life and their entire livelihood was all about educating us. And it's because of that, you're on that constant hamster wheel for educating. And that is why at the point of their retirement is when they're realizing, wow, I don't even have a pension. I don't have, like, they've spent. That's why black tax is a thing, and that is why black tax exists. So I would want to advise you from that aspect of as you're taking on like the life insurance and you're putting in the trust fund, because I know I hope Mnindo, you're gonna take some time there on like the trust fund aspect of it. I also would want you guys to realize that there's room now for also investing. Think cash flow. If you're trying to accumulate money for your child's education in the next 5 years, 10 years, 14 years, you need to also look at it from, your child's education is something you need to invest for. Okay, so I just wanted to chime in on that as well. Now, there's someone also who is asking, what happens if I never received? Mnindo, I told you this is it's a possibility. I told you I've seen this. What happened if I never received my policy document? I realized,
That is a red flag. That is the reddest red flag. Like, imagine what I tell
I
you.
realized, so she's saying, I realized later that the company input my postal code wrongly. My agent also passed away some months after I signed the policy. The maturity is this month. Do you think I will be bothered? So can you talk a bit about this whole aspect of the things that you must have once, I think the policy document in the sum assured, yeah.
Guys, think about it like you've bought property and you didn't get your title deed. That is how serious you should be taking that policy document. Like literally, especially for the people who got it pre-COVID, there used to be physical documents. So if it's a physical document, please even go and scan it and have a soft copy. Because before even to apply for life insurance, you had to actually fill in papers. It's just now post-COVID, now at least they were sending soft copies. So if it's post-COVID and you've not received your policy document, there's a very, very big question mark there. So as I'd mentioned, sometimes not a lot of this one thing you have to understand. Sometimes people just focus on the sell. I've made my sell, I've made my commission, but not everybody thinks about, have I done the best for this client? Have they received all the requirements? Which is now you need to make sure you've received your policy schedule, you've received your policy term and conditions. So all of this is what makes the policy document. So the moment you sign up, immediately, you know the way they were breathing on your neck to buy it, now breathe on their neck to receive your policy document. Now they immediately receive your policy document, go through it. Just take 1 hour. Like guys, you're going to pay this thing for 15 years anyway. Just take 1 hour out of your day, right, to go through it. Make sure that whatever is captured in the policy schedule is correct. Let me tell you something. If something as simple as an ID is wrong, your people can't even claim it. Are you understanding the repercussion? Imagine you took this policy so that now people don't have to fight for things and there's access. Now imagine you put the wrong ID number of your wife. Now your wife comes in, yes, she's called Judy Kamau. But now instead of putting 085 at the end, you put 086. So who are you? The insurer will be like, who are you? So you have to make sure that you get that document and go through it. First of all, the policy schedule, to make sure that everything that is you put in the application form, you have it. So what we usually advise, have a copy of your application form, because sometimes people play a lot of games also in this space. They don't, when you give the agent your application form and you didn't have your copy, you never know. Sometimes people will either change a thing, or maybe you might not even remember what you actually filled in. So always have a copy of your application form, put it in a folder, Google Drive. Now, guys, we have no excuse. Please just open a folder that you call My Money folder, have the application form, have the policy schedule, and then lastly, go through the policy terms and conditions, because that is where the flesh is at. Because that is where now you'll understand what is excluded and what is actually covered. So you have to understand, what did I sign up for? You would even rather pay someone 5,000, 10,000 shillings to go through that document, compared to you years later, you've lost millions or hundreds of thousands. So those first 30 days are so critical. So for anybody who's had this policy for 30 days and it's not making sense, you can actually, as I mentioned, cancel it and get your money back. So go right now. If you've taken a policy just the other day, go through it. And then now it's again another way to evaluate your agent is to ask them many questions. If you see someone, you're asking them question and they're feeling some type of way, please put question marks. Some people catch feelings. Yeah. They'll be like, oh, kwa mtu ananisumbua. But remember, this is your hard-earned money. Guys, you need to actually start treating your money with respect. Yeah. How you cannot say that you're working so hard for this money and you're not even treating it with the respect it, because you're putting this money in a policy you don't even know. Like, it's like literally you just are giving someone money and you don't even know what you got into. So this is not now to make you feel bad, but all we're saying is, even when you are dealing with money, whether it's investment, whether it's insurance, please, to some extent, work on understanding what you're getting yourself into, so that now it will reduce now feeling that you are played later, or now this is something it was not really matching your goal. Now this is 3-5 years down the line, because remember, with life insurance, it's dependent on age. 5 years down the line, if you realize it's not the right thing, you'll have to pay more for a similar policy. You see. So please take those first 30 days critically. First of all, I tell people, even those first 10 days, don't wait for the 30 days, because I know some people wait until the last 30th day. Just those 10 days, immediately you receive your policy document, always ask your insurer for your policy document. So if your agent has not sent it to you, make sure that you follow up with the insurer. Yeah. So always make sure that even the agent is keeping the insurer in copy when they're even sending out the application. So in case your agent is, like in this case, has passed away, or your agent now has moved companies, you can still have direct relationship with the insurer. This is why also, and it's an added advantage of having an independent agent, yeah, compared to someone who's tied. Because sometimes the ones who are tied, one day they're working for this company, tomorrow they've moved and they're working for someone else. Yeah, so yeah, that's very important.
Thank you. Ngindo, there's someone who was asking, I'm barely a month into an endowment policy. If I decide to cancel it right now, will I get anything back?
You get your premium back, the first premium. If it's been barely 30 days, you can get your premium back.
Okay. Someone else was asking, I took an education policy and got to a point I couldn't continue premiums due to loss of a job. Then COVID hit and it wasn't a priority. I followed up with my agent. Once I got back to my feet and the options provided meant I would lose more than I was willing to. So I chose to let it mature. Will I get even the principal at the maturity date? So maybe you can address that with someone else who was also asking, what do you mean by a forced loan? If I let's say I wasn't able to pay in a particular period, or due to either job loss or whatever, what should that person do?
Okay, so let's say now let me start with the what is the forced loan or the automatic loan, and then I can address the other question of someone who has lost their job. So what happens, but now the automatic loan only comes after your policy has received, has what we call a surrender value or cash value. So this is mostly 3 years of contributing, yeah. That means that, let's say, for example, you've contributed for 4 years and then you just stopped paying the plan and you didn't even give the insurer the reason why. So what usually happens, remember there's a cash value that has been accumulated from your savings component. They're going to take money from that cash value to pay into the plan. So it's automatic. Yeah, it's usually part of the policy terms and condition. So they don't have to come and ask you to cut that money out. They will automatically do it as long as there's surrender value or there's cash value. From the savings component, they're going to use it to pay your premiums automatically until that amount of money is over, or until now you come back and catch up with it. Yeah. So that's what an automatic loan. It's different from now when you take a policy loan. Now you're like, okay, I need a loan now. I need maybe liquidity. So I need a loan at this point against my policy. So with the automatic policy loan, used to pay the premiums, the amount of money is given to the insurer. But now for the policy loan just by itself, you're the one who's receiving the money. Yeah. So that's the biggest difference between the automatic loan and now your policy loan. And then now, please repeat the first question, Susan. The one that someone said that they've paid over a period of time. Did they say how long they've paid
Yeah, so they they took an education policy, got to a point where they couldn't continue premiums due to loss of a job. Then COVID hit and it wasn't a priority. So after she followed up, she realized that the options provided meant she would lose money either way. So she's wondering, will she even get the principal at the maturity date? Like, will she be able to get whatever it is that she was promised, even though she hasn't been able to pay?
Now we're taking consideration now she's maybe reinstated this policy, because most probably this policy lapsed and now she's catching up. I don't know. The thing is that I don't know what are the options the insurer gave her. Like, is it now to reinstate the policy, or what could be what exactly did they tell her? Does she have to continue to pay the lump sum of whatever it is that she missed over the period of time? So you see now, based on whatever the answer is, we just need to do the math. You need to just do the math of what am I going to put in? What have I already put in now? And if I was to continue from now until the policy matures. So you can calculate all the amount of money you've already put in, and then you ask the insurer, what am I getting out? So you can evaluate. Yeah. So at that point now you will know if you will get your principal back. If the insurer tells you this is what to expect, and if for you do your own calculation of the premiums you're going to put in over that period of time, of how much it is you've put in. So now to be able to make that decision. Because sometimes what happens is, to some people, even like stopping and now starting afresh could even be cheaper. and starting with a different plan. So it's good to now do an evaluation of your numbers and see what makes most sense. Literally money in, money out. Yeah. So that you see, this is the amount of money I'm putting in as premiums. This is what the insurer is promising me. Am I going to make my money back when I see the numbers? Yeah.
Had you addressed the difference between a pure term cover and a whole life cover? Someone also asked about that.
Okay. So let me explain. So a pure term policy, just you see now with the endowment policy, is also for a specific period of time. I think I'd mentioned that. So a pure term is also for a specific period of time, but it does not have the investment component. A whole life, the difference is it's now doesn't have an investment component, but it lasts the rest of your life. That's the biggest difference. Term is for a specific period, and then whole life is for the rest of your life. So term is really good for maybe mortgage protection, because mortgage has a beginning and an end, or for people like us, when we take when we take loans for our business, and in case something was to happen to me, I don't want my business to be touched or my estate to be touched. What I do is now I do share the, what do you call this? I can take actually a term life cover, because if I've taken only a 5-year loan, I don't need a whole life cover for that. So term life is for specific period of time, whether it's 10 years, 15 years. So when the term is over, then it's not like you receive money at the end. Yeah, it's literally just like a motor insurance. If you get an accident, you'll be paid. If you don't get an accident, you don't get your premiums back. With a term life, is same. If you get a death, disability, or critical illness within the period, there's a payout. If nothing happens, it's a wrap. Although there's some insurers who are trying to there's return of premium, but those policies end up being very expensive. So with a whole life, even if that time period of paying the premium is over, you're still on cover for the rest of your life. So it's temporary payment for long life protection. That's the difference.
Okay. So a lot of the other questions are about trust funds. So I think we can get into the meat of the trust funds after we have addressed the real life numbers, right?
Yeah. That's okay.
Okay. Maybe you can continue for now.
Okay, Sawa. So it's good for us to look at the numbers. So this is a policy of one of our clients. So it's always good to now have real life examples. So for her, she was contributing, let's say now 10,000 shillings. So I want us now to go to a calculator. Give me a second. So that now we can see how these numbers are looking alike. And we can actually have, Susan, I wish I could open that calculator that you have, or you can open it, the one which is in the Legacy Hub, and then now I feed you the numbers.
Yeah, the compound interest calculator.
Or I just do it here with okay, let me just open this one so that now we can just have it. So now let's look into this. She's contributing 10,000 for 9 years. So I wanted us, because for her, she was looking at it from a returns perspective. Yeah. At an interest of, let's say, about 12 for the next 9 years. Yeah. And she's depositing 10,000 every single month. Okay, so you can see the amount of money, if she was just to put it now, whether it's in a trust fund or a money market fund that is growing with compound interest for 9 years, should have received 1.958 million, right? Let's say about 2 million shillings if she was consistent with the 10,000. But you can see here with the policy, let's look at it. Yeah. So here the frequencies, monthly 10 years, started 2024 to 2033, that's 9 years. And then now what it does, you can see here the total premium over the period of time is, you can see there are 720,000, because that's 10,000 times 12, that's 120,000, 120,000 times 9 years. 120,000 times 9 is, Susan, that's over 1 million. 120,000 times 9. Yeah. But you can see here, so here they're saying total premium payable, because they're not including like now the policy fee and all of that. But you can see here, let's look at the survival benefits, the cashback bonuses. So the first year, there's the 204,000, then another 204,000. Let's say there's 204,000, the way this policy was structured. So she's going to get 818 million. But for me, when I calculate the contribution is even more than this 720, right? Susan, please just confirm for me.
Yeah, for sure. It is. It is.
Is it a million?
Yeah. Because 120 times 9 came to around 1,080,000. Yeah.
Is this even legal?
I mean, it's yeah.
Yeah, they're putting total premium paid. Okay, let's try 9,675 times 10 times 9 times 12 times 9.
So times 12 is 116. And then if we do that's per annum, so times 9, it's around, actually it's 1,044,900. So you can actually see. Yeah.
Yeah, so you see, hey, then here, then what does this anyway? Sorry. So let's just say,
Mhm.
even if now we were to go with their numbers,
Yeah.
contribute 720 to get 818.
Yeah.
But if you do with our numbers, 10,000 times 12 to me is 120,000. The last time I checked, 120,000 times 9 is 1,080,000. Yeah. So 1,080,000 that has gone in versus the benefit again. Hey, this one. And I literally just took it as it is, yeah, from the my client's profile,
Yeah.
my client's policy schedule. This is why, guys, when you say look at your numbers, these are the things that we mean. Don't just take things at face value. Go and do your own number to make sure that what you're actually contributing. Because here, 720,000 means that person has contributed for how many years? Like, let's 720 divided by 120,000 is 8 years.
Yes. Yeah.
Is it 8? No, it can't be 8.
6. It's actually 6 years.
Yeah, please make it make sense. Because it's like a calculation for 6 years. Yeah. Anyway, that is one policy to look at now the numbers, right? And as I'd given now an example of now even a pure life cover. And are you seeing that the sum assured is 204,000? She's paying 10,000 for a sum assured of 204,000. In short, if she was to pass away today, the family gets 204,000. Please, guys, ask yourselves with the sum assured that you have, how long will it take your family? So when I asked her, she said this can barely take her family a month. 204,000. Like you've exited this earth. You are like adios, amigos. Yeah. So 204,000. I don't even think after everything that has happened, it can even take even care of school fees. Now, let's say now this is immediately. Because remember, the rest of the money is paid upon maturity, according to how this policy was structured. So even for the people who take education policies, one thing I realize is there's usually a very huge gap because most people don't think about food, clothes, and shelter. People are like, education. And then the second thing I want you guys to ask yourself, 204,000 in the next 5 years, what school fees is that paying? 204 per year. Yeah. What is the school fees that, because I want us to put into consideration inflation. So maybe 204,000 at that time could be an equivalent of maybe 90,000 today. That's another thing a lot of you don't put into consideration. Yeah. So yeah, that's policy one. I don't know if there's any questions still there.
I think a lot of the comments are just pure shock in the comment section. I'm really laughing over here, man. As in Akisiatin. It's guys, I hope we're not laughing at you, we're just laughing at the reactions, but like I'm really happy. Actually, someone in the comment section posted something that has really humbled me, and he's saying that you guys have no idea you've saved generations with this webinar. So it's really good. If you do not do anything else after this webinar, just always make sure you run the math, because what we've done in this webinar, we've just done the maths, right? But yeah, pretty much I think we are doing well.
Yeah, we really, really are. Okay, so let's look at number 2. So this one is a policy for this is another client. So their premium the start date was 2022 to 2031. That's how many years? That's also about 9 years,
9 years.
right?
Yeah.
So they're paying an annual premium of, let's say, about 120,000 because they were paying lump sums. So let's do 120,000 times
9 years.
yes. The
That's
exact.
around 1,080,000.
Are you seeing the sum assured? Yeah.
Mm.
So what we okay, let me open this. So there's the sum assured, and then there's the amounts of money. See, now there's the first cashback date, and then there's all of those. Let's just say at the end of the day, the amount of money would be more or less exactly what they've put in. Yeah. So this one is just a bit better than what we've just seen previously. So this one, they're going to give it because there's 2027, 2028, 2029, 2030, and 2031. So how it is that they structured this one, there is now some money that they're going to be receiving. Just to see the way here, they were receiving like about 200,000. So the same thing here. It's just that this one will just be a bit more because now this will be the 800 and something thousand plus some amounts, which still, if we were to run the numbers, it's going to be more or less exactly the same as what we had done. It will be now the whole 1.9. Hey, these ads. The one point almost the 2 million. Yeah. So it's 2 million, like literally they are receiving half of what they would have gotten if they actually put it in an investment or even a money market. This is not even like an investment that is growing with a big percentage. This is now something so conservative. Yeah. Okay. So my God. Okay, sorry. So let's look at it. Yeah, so this is the other thing I wanted us to look at. When I tell people to go through the policy document, this is the thing that I want people to look at. So here, the death benefit for this particular policy, this one that we've mentioned, you see the way with life insurance, what it's supposed to do, when someone passes away, the whole sum assured is paid. Remember, this is a sum assured of about 885,000, right? But here they pay according to when you die. So if you die in year 1, the family gets
What?
10%. Yeah?
Sorry, I was just.
Yeah. So this one pays according to when you pass away. So you can see here in year 1, 10%. So it means if you are to pass away in year 1, the family gets 88,546. Yeah. This is if you die in year 1. This is why you see when we say read your policy documents, these are the things people don't read. So you go and you're like, oh, the sum assured was 800,000. Why am I receiving 88,000? But you can see here it was written death before the 5th policy year. On the death of the life assured, before the first day of the 5th year, within the first 48 months from the effective date, when this policy is in effect, we shall pay a percentage. You see, it's written, so it's not like they're lying. It's just that you don't read, yeah, of the amount of insurance as set out in the table. So if you die if someone was to pass away in the 2nd year, the family received 20%. That's about 160 something thousand. Let's say about 170K. And then here it will be 300 and something thousand. So in short, if you die in year 1, it will be like pole sana, but your family is not deserving of the replacement of income from this policy. So we are only going to give them 88,000 because I don't think we made enough money from this plan. So please, for the love of your family and yourself and the money that you're making, go through the documents. So the only time that the family can receive the full sum assured is after 48 months. And it's written here, the above percentage shall apply irrespective of cause of death. You see the way most plans pay at least double in case of an accidental death. Here, it doesn't matter whether it's an accidental or natural death, the family will still receive. So here, what I'm seeing is an insurer trying to really protect themselves and at the detriment of the customer, right? So to me, that is a very big issue. Actually, if there's a policy I could say I detest, is this one. Yeah. Mm-mm. So, okay. So let me say what's next, and then we can go now deeper into the education policy. So if your cover is less than 30 days and it's not making sense, guys, you can cancel and get your money back. Yeah. You can always cancel and get your money back. Just say, I went through my policy documents, I'm not comfortable, and I want my money back. You actually put it in writing. Yeah. And they have to pay you back. It's your right. And then, so again, go through your policy document. It's usually put there in writing. So again, make sure that you hold the words which are written in the policy documents over whatever your agent tells you. So sometimes what agents do, they can even write for you in a piece of paper, and they'll never leave you that piece of paper. They will do the numbers, it looks good, and they'll go with that piece of paper. So you don't even have evidence. So if someone was to do for you numbers in a piece of paper, say you want the piece of paper. So you always remain with your evidence. You can even tell them to go to the extent of signing. If whatever it is that they believe they're telling you is the truth, let them sign on that I say this and this is what is the truth. So it's always important to have your communication. So even if now you're done with the meeting with the agent, you can go back and put an email. Based on our conversation today, this is what you told me. So you put it on writing. So in case life was to happen, at least now you had sent it on email, and you have to make sure that they acknowledge it if they have nothing to hide. Yeah. And then number 2, if cover is more than 30 days but less than 3 years. So remember here, if you're to cancel, you don't get your money back because it's not reached the 3 year where it's accumulated some sort of cash value, surrender value. So here, depending on how far along you've gone, sometimes you can just cut it off completely and just be like, you know what, the amount of money I've lost is going to be so much less than the money I'm going to start moving forward. Or another thing you could do is you could ask for them to reduce the amount of money you're contributing per month. So if you're contributing 10,000 and maybe you don't want to lose the money you've put in already, you could just tell them, I want to contribute the minimum. And for you to contribute the minimum, at least you would have salvaged to some extent. Yes, not fully, but it's the difference. Let's say you are contributing 20,000 and you don't want to completely lose the policy. You can just say, I want to contribute the minimum, which is 2,000, and that 18,000 you can put it somewhere else. Yeah, so that you don't lose the money you've already put in. So again, this is where an analysis can come in. So you can be like, okay, does it make more sense for me to leave or for me to reduce the premium and continue? Yeah, based on whatever it is I've already put in, or I completely start afresh. Yeah. And then, so if you need any help with that, we can also be able to guide you. We offer that as a service, and we'll share the information on that. Yeah. And then if it's over 3 years, not yet matured, that's also another thing to look at. So you could now convert it to paid up, as we had mentioned. You can stop contributing the premiums, and then the insurer gives you the new sum assured, which you're going to receive at maturity. Number 2, if the surrender value is not too bad, you could choose to surrender and pull your money out, because after 3 years, there's a surrender value or the cash value, so you could pull your money out. But majority of the time, you cannot outsmart the insurer. Yeah, they've done their math. Yeah, these are actuaries. People have done their math. So it's now for you to see, okay, what makes most sense. So number 1, convert it to paid up. Number 2, you could surrender if the numbers make sense. Number 3, you could still do like what we did in the previous option of reducing the contribution to a minimum so that you don't lose the amount of money you've already put in. So those are 3 options. Yeah, please, I hope you've put them down in writing somewhere. If it's close to maturity date, naweza kujikaza. Yeah, you can hang in there. If it's a year 2, you can hang in there and just finalize. Yeah, so depending on what stage you're at, it's good to do an evaluation and see what makes most sense. Yeah. So that is it for now, how it is that you can separate. And then now I'm going to answer the questions on the trust funds. So I'd put the frequently asked questions. I think I'd forgotten to put them here, but it's okay. If there's any questions so far now, I can take them and then we can go quickly oh, it's already past 9 o'clock. Jesus.
I know. This is so good. There's so much to be discussed. My camera was off because my baby boy had woken up. That's why I was on and off. I'm so sorry. Okay. So I guess the first question I would want us to address is the trust fund question. I want to ask it in twofold, just given the comments that the questions I've read in the question sticker. The first thing is, how do I set up a trust fund? And number two, who benefits from the trust fund? The contributor or just their loved ones? So maybe just explain the trust fund in totality and why it is something that maybe people should consider.
Okay. So, as I'd mentioned before, a trust fund account, it works similarly to a money market fund. The biggest difference is the extra layer of legal protection in the fact that in the case you were to transition, the family did not have to go through the courts. So think about it as a central pot where you're putting money aside, where it's also protected not only financially but also legally. People cannot misuse the funds, right? So when it comes to the trust fund, because of the level of flexibility, you as the person who's creating this trust fund are called a settler. And then there's the people who are benefiting from this trust fund who are called the beneficiaries, right? And the person who's actually managing this trust fund is what we called a corporate trustee. So it's an institution that is managing this fund. So the person who benefits is whoever it is that you've picked as beneficiary. But even for you as a settler, you can benefit from it because you can be a beneficiary of your own trust fund. So this is why we say everything has to be goal based. Why are you opening this? So if you're opening this for your kids and for the protection of your kids, so the person you want to benefit is the kids. But if you wanted access, you can still access. It's just that we try not to access if we can minimize it. Because again, if you're putting money aside for your kids' education, you don't want to always just be touching that money. But yeah, you also personally can benefit from it. You can also open a trust fund for yourself. Yeah, or your kids, or even your parents. Because for people who are much older parents, and you want also some structure in their lives because they're fully dependent on you, you can also open a trust fund for your parents. So just think about it like it works just like a normal money market fund account. Just that it has an extra layer of legal protection and the fact that you can actually put instructions on how you want the funds to be distributed. Yeah.
Yeah. Okay. That's really good. Maybe for the people who are wondering what do we mean by legal protection is that most, if not all of the things that you own right now, your money market funds, bills, bonds, land, houses, apartments, the moment you die, including bank accounts, the moment you die, all of that is frozen. Like no one can access it unless like they had your PIN numbers and whatnot. But like from that particular point onwards, everything for your children, for your spouse, or whoever you cared for to be able to access those things, you have to actually go to court through, like it has to go now through probate, the succession court and whatnot. And of course, if you did not even have a will in the first place, like the courts are now everyone has to go to court for the courts to determine how these things will be distributed. So, our African culture, if a magical wife appears from somewhere else with her 3 other children, now your 2 wives and the children, everything will have to actually go to court. We have to say the honest truth. So why people set up trust funds is that the trust fund does not go through probate. The other thing that usually doesn't go through probate is life insurance. Life insurance within 7 working days, the beneficiary will receive. So we actually do set up a trust fund for when Nyindo says that extra layer of protection, it means that you are just preventing that whole back and forth of family members fighting, arguing, going to court. You already put up the trust fund in place. You put instructions. I wish Nyindo had been able to pull up like what I've done for my son. We put very specific instructions. Like you can actually on the grant letter you can indicate, like for my son we've indicated.
Actually, I have an example grant letter in the
Oh,
type B.
awesome. If you have an example of a grant letter, because in the grant letter you specify, like you're able to put specific instructions like, I would want my child or my children to access this fund only when they're 22 years of age. Like even for me, I put an extra layer of protection and I said 70% of the money in this fund will go towards school fees, and the only time that the money should be released is upon provision of an actual invoice from the institution. So what you've done is that you've prevented the money even going through, like, a relative's hands who may or may not be faithful in terms of where they're taking the money. So like the trust fund knows that if someone wants to take money, they have to actually bring an invoice from the school. Then when the invoice from the school comes, the trust fund will pay directly into the school. So there's no actual person who's actually handling this money. That's what we mean when we say that additional layer of protection. Maybe as Mnindo is pulling up the trust deed, you can just be scrolling it for people to see what that looks like.
So now it's important now for you to know. So what you're going to do is to fill in an application form. And then after filling in the application form, maybe after this, I can see if I can pull an up so you can see how that looks like. So that now you can understand. Or maybe I should pull that up first. But anyway, this is our grant letter. So you as the settler, you're the one who's creating this trust fund account. And then this is the trustee, the person who's managing. Because remember, as I said, it's a corporate trustee. So this is how it looks like, because now this is now your instructions. Yeah. Now, where the trustee has established the trust for the intent. So this is where the intent comes in, whether you've chosen as education, medical, or upkeep. So it's up to you to decide. So when you're filling in the form, you'll say, do I want to use this trust fund account for education, medical, or upkeep? Okay, so for me, how I've structured mine is I wanted to take care of everything because all my life insurance proceeds come in there. And I want to know that there's going to be continuity in my kids' life. Yes, in their education, very critical. But medical care, now someone can be able to purchase for them medical insurance. And remember, Susan has said it's paid directly to the institution. So nobody's touching that money. The only money that is touched is upkeep money by the guardians, because for day to day, you cannot expect the trustee to send money to a clothes shop or to a supermarket. So that's the amount of money that the guardians will be touching to take care of your children. So they have to say, okay, where are you currently situated? And then now you have the initial capital. Most of the times people put the first 5,000 just to open the account, declare the source of funds, e.g. being the beneficiary's share of, the death benefits of X companies. So you have to put them down like that. And then you see here, for the general purpose of the trust declared in the trust deed, towards the general welfare so here you have to mention the beneficiaries. This is why, as I feel, it's important to make sure that everything is done correctly. This is why we have to have the children's birth certificate, to just also make sure that whatever you've put in the application form is matching whatever it is that is in the birth certificate. And then upon trust for medical and education and educational and upkeep, directed wholly towards the general fare of and now the beneficiary. Yeah. So all these things, so you can see here, it's for medication. So it stipulates what exactly is the medical needs. Medical needs, including but not limited to medical covers, life assurance policies, payment of charges. So anything that is for the benefit of this child or whoever it is that you've chosen as beneficiary. So even if there wasn't medical cover and there was need to pay money into the hospital, the money can come out of here. Education needs, yeah. But of the trust, including but not limited to payment of school fees, to school tuition, activity fees, because sometimes it's not only school fees, it could be now provision of educational equipment, expenses, apprenticeship program, just anything to do with the education. So you see now when you are structuring it that way, so when, let's say, for example, you had exited this earth, and why we say that there's that level of continuity. So if someone comes, the guardian comes, or even the whoever it is who's taking care of the child, and like this child requires these things for school, the trust fund the trustee has to send it to take care of all these things, and then to provide money for upkeep amounting to X per month, right? Or you can say upon request of the guardian, how much do you believe your child might need per month for upkeep, whether it's food, clothes, shelter, yeah, to meet provision for food and clothing, yeah. And then now again here, you can see here, the trustee shall hold funds in trust until such a time the beneficiary has attained this age. So a lot of people pick 23, 25 when they believe the children are done at least with university. They feel like they have a better understanding and management of the money. So that's when they receive the lump sum. Yeah. And then or an earlier period, now the balance of the funds or earlier when the balance of the funds is zero. So if there's zero, obviously there's nothing that will be transferred to them, but if there's money, it will be transferred to them. And then eventually the trustee will send a summary of accounts to the beneficiary. That's the other thing I like, because it's very transparent. So even with this one, every month you do get a statement, but now they're also working on a portal. At least hopefully by the end of this year, the portal should be up and running. But as I said, at least now from one thing I've seen is the returns have become so much better, because they're trying to give better returns than the money market funds. Yeah. So yes, so for ease of identification, the trust fund shall be referred to. So you have to name the trust fund. What name do you want to call it? You can call it after your kids. I personally put my 2 kids' names together and I called it that name trust fund. You can be creative on how you want this trust fund to be named. So if your child is called Edward Kanyi, you can call Edward Kanyi Trust Fund. So if you have multiple children, you can use one trust fund account, or you can also open separate trust fund accounts for separate kids. And then here, in the event of any dispute arising, between the settler and the trustee arising or relating to the grant letter, the parties shall use their best effort to settle these disputes or differences amicably. So they're trying not to go to the courts. That's the beauty about trust. We try to have this conversation first and to see how we can sort out this situation. And then any dispute that has not been settled, now it goes to the next level, which is arbitration, provided in the trust deed. Yeah. And then the arbitral award shall be final and binding on both parties. Because you see, what we're trying to do is not to go to the courts. Yeah. So that's why it's important to understand how these trust funds work. Yeah. And then the seat of arbitration shall be in Nairobi. That means so before you had to actually show up physically, but nowadays they are more flexible. You can have a virtual session. Yeah. And then here, the settler has at any time be at liberty to remove the trustee from the office by giving. So if you want to cancel your trust fund, you can cancel. You can stop. Yeah. That's the thing. Yeah. And then the guardian of the beneficiary. So you have to list down your guardians. So there's the primary guardians, and then you can have now alternate guardians as well. So there's part 1, and then you can, just in case now something has happened to the main guardians, they'll go to the next level of guardians. So the fees charged is usually 1% charge quarterly. So let's say, for example, what is in the fund is 100,000. So 1% of 100,000, that's about 1,000 bob. So charge quarterly, that means it's 250 bob. So it means it's barely even touching the interest, yeah, calculated. So the VAT charge is already included in the 1%. So don't worry about that. So the trustee will debit. So even when we're giving you the percentage of 10 to 12%, all this has already been removed. Yeah, the 1% and the VAT. And then after that, you have to sign, yeah, and then you also, the ICA people have to sign, and then it's legally binding. And then with that, you have already created your trust fund account. So you can now continue contributing. I personally contribute. So if anybody wants to contribute money to my kids, I send them the M-Pesa details. So you can even make it a family thing. So if someone wants to give to your kids, they can send to the trust fund. So even nowadays, we've seen with a lot of our clients, nowadays they're changing how they're gifting. They're actually gifting trust funds. So even like in baby showers, we've had people who are opening trust funds for the kids even before the child is born, which I'm like, that is so cool. So the amount of money, they've put it together and they've set up a trust fund to sort this child out. Yeah, so that's how the trust fund account, you just fill in the form, which is going to capture all these things, and then they're going to put it now in the grant letter.
Thank you so much, Mnindo. That was very insightful. Someone else was asking, like, for the trust fund, can one deposit a lump sum, or can the monthly contributions vary? I think I can answer that. This is totally self-paced, guys. It's not like a contract agreement like what we are just from discussing in terms of the insurance. Insurance is the only product that requires that kind of consistency. However, for the trust fund, you can actually, fund at whatever time. Okay. So if you get your 5,000 here, well and good. If you don't get it this month or in the next 7 months, it's okay. If you get 500K, well and good. Also, some of your other investments could pay into the trust fund. For example, your life insurance. Again, remember, if you do not want the life insurance to go to an individual, let's say if your children are, because remember, if your dependents are minors at the point of your death, they have that money has to go to a guardian who is not a minor. So to avoid that again, we are seeing people also putting, like, instead of the beneficiary of my life insurance to be my son, the beneficiary of my life insurance will be my son's trust fund. So number one, your life insurance can pay into the trust fund. The second thing that can pay into your trust fund is your pension fund. So your pension fund can also pay into the trust fund. So you see, those ones are just haphazard lump sums coming in. And also maybe if you have bonds and the bond pays, let's say, a coupon, you could decide to even have the coupons go into the trust fund. The point of a trust fund is that you want a pot that collects money that you don't want to go through court. Okay? Your trust fund is a pot that collects cash. Remember, this is a trust fund, so it should be collecting cash. So this is cash you want to stay somewhere where, in the case of my death, this thing will not go through court or it will not go through probate. Okay. So Fragrance is also asking, can one open a joint trust fund account between spouses? Yes, you can both be the settlers of the trust fund, both you and your spouse or something of that sort. Okay. Now, Mnyindo, there are so many people who are asking, who is offering these trust funds in Kenya? Hebu waambie ni kina nani wana offer.
Okay, acha nikuambie. So far we have ICA Lion. They're the ones who've been longest in the business of trust funds, and they've been there for 20 years. It's so interesting that the people I'm speaking to have never heard of this plan, the cash management trust, and it's been there for the longest time. Yeah. So they have the biggest assets under management, the biggest portfolio so far. Right? The other company that offers it is CPF. Yeah. And then the other company that also offers it is Britam. But so far, based on my research, ICA Lion has been the one which I'm most comfortable with. And I like how they've created their structure. So the others I still keep on checking. And in case there's any updates, I always let my clients know. Yeah. So that in case there's a better alternative, remember, you can always change it.
Yeah. Awesome. Louise is asking, I think I can take this question. What is the best education plan, cash flow in mind for both when you are present and also cover you for when you're not present? Also, can you start even though you currently do not have kids? If yes, what happens if you pass on before you get the kids? Awesome. So I think Mnyindo has already given us the aspect of covering, which is like, for me, genuinely, I feel like a life insurance and a trust fund are like double trouble. That's like the best combination to, like, it's if anyone would ask me, how can I protect my kids in my absence, combine those two things, like have a life insurance and a trust fund combined. Okay, now let me answer in terms of cash flow, guys. So there are two ways to think about investing for your child's education, because remember, we've said that there's the protection aspect of it, which formed the bulk of what we've been discussing today. But now there's the cash flow aspect of it, where you're like, okay, now my kids are in school right now as we speak. What are the options? So we have education planning for the short term, and we also have education planning for the long term. Now, if you want to do for the short term meaning, like right now we are in July, we know kids will funga maybe in August, and we have this, we have like the normal calendar, for example, here in Kenya. So the thing is this, if you know that as in every 3 to 4 months, let's assume your child's school fees comes to like 80K every term. I've always advised my clients that in the short term, instead of just kind of like, surprise, now we are going back to school and I need 80K, you could look at it in terms of, okay, between January, February, March, April, you see, you have 4 months before you have to come back for the May semester or the term that starts in May. Then from May, you have May, June, July, August before you have to pay again for the September. So each of those, you have like 4 months to accumulate, let's say, 80 Gs. So realistically speaking, if you actually work backwards, you realize that if you could put aside, let's say, 20,000 in a simple money market fund every month, by the time it's 3 to 4 months, you've already kind of like accumulated what you need. So for me, I always advise my clients that for the short term, just use like a simple money market fund. This is money that you're accumulating to spend. I'm not talking about long term now. I'm just saying like this is money I need next term, and then next time again I will need money. It's good to kind of like just have a system ongoing. And this is something I keep advising all parents. Every parent must have what I call a children's sinking fund. And a sinking fund is just that simple money market fund, because children are a walking Excel sheet. If it's not school fees, it's co-curricular activities. If it's not co-curricular activities, it is school trips. If it's not a school trip, it is today you bought a uniform for tennis, they have outgrown tennis, now they want to play football. There's all of that. Like, it's an ongoing expenditure. So for the ongoing expenditures of your children, just have like a simple money market fund that you're like, I put money in this MMF on a monthly basis, so that it's like a sinking fund is money you're saving to spend. All right. So you're constantly putting in money. And that's why we are saying just do it in an MMF, because you'll put money there for like 3-4 months, you withdraw. Another 3-4 months, you withdraw. It's just to have somewhere to do. You can, if you have a spouse, you can actually, contribute the both of you. So that one is school fees planning for the short term. However, if you're like me and you have a very long way to go before your child goes into school, because I feel like for the short term ones, like, we can bootstrap. However, I feel like the rain starts beating parents at high school and college level. That's where, for the parents who have children in high school and college, maybe you can let us know in the comment section. But a lot of my clients, that's where the rain is beating them. And that is the reason why we buy these policies for 15 years, 20 years, because the plan is that by the time my child is in high school or in college, I have something in place. Now, inflation. I want you to always have that in mind when you're thinking about cash flow for your child's education that requires years to plan for. So like right now, if you have a very young child or young children, you have maybe 5 years to go, 7 years to go. Some of us have even up to 14 years to go before your child actually has to go into high school. Now, I want you guys to imagine 5,000 bob 5 years ago, and 5,000, if I gave you 5,000 shillings and told you to go to Naivas in 2015, and then right now I give you the same 5,000 and I tell you to go to Naivas, you will not come with the same bag. Right now, the bag is lesser, it's smaller. So when you're thinking about where should I actually be investing money for my child's education, I need you to think inflation. So if inflation in Kenya is at, give or take, right now, we are looking at an average of 6 to 7%. If you're trying to invest for your child's education and you want cash flow, I need you to get into avenues where you're getting way above the inflation rate. Because remember, you want to be compensated for inflation. So if it's at 7%, you want to earn way more than that at 10, 11, 12, 13%. So if you're, of course, if you're already doing money market funds, remember money market funds are low risk, low return. If you do not mind risk, I would urge, for us to invest in things that give us a slightly higher return than the money market fund. Especially because it is for the long term. You can always divest before your children require the money. So I'd want you guys to look into the mutual funds that we have with some of our banks, with some of our unit trust companies. I would urge you people to look even into things like the special funds that we have right now that are giving us access to the global market. I'd urge you to look at investments like the bonds that could easily, begin to, let's say you can even, depending on how much you have in lump sums, you could even have the bond coupon coming in, reinvest it somewhere else. So think cash flow, think, of course, we can't mention all the investment. Maybe we can plan another class to talk about the actual investments in depth and in detail. But like a hack I can give you guys is make sure you are being compensated for inflation if you want to invest long term for your child's education, because that is like the school fees we are paying right now, guys. In 14 years, it's probably going to be double. what we are paying right now. So I need you to think, what are the assets that we have in the market that can actually double the amount of money that I have right now in the next maybe 14 or 15 years. All right. So I think that's what I would say. Mnyendo, a question for you. Do the trust funds send monthly statements like an MMF for someone to see how their money is growing?
Yes, it does. Yeah,
They
it
do.
works just literally like if you have had, you know, experience with a money market fund, it's exactly the same.
All right. Okay. No, there's this. I don't know. Will you take this question? Could you expound more on Imarika Britam? Is it a policy investment or is it a life insurance? I don't know if you can take that.
So unless someone brought the actual document, there's so many
Yeah.
there's so many of them. Like there's Imarika Braditam, there's so many different types, unless now someone showed me. But I think that one, if I'm not wrong, I think it's the savings product.
Mm.
And anyway, like let me not guess. If they had the document, it would have been easier for me to say. Like I don't want to butcher it just in case. So it would be
Yeah.
good for me to the actual product. That's why we had asked if you could just share it before, so I could go through it and we analyze it together.
Okay. Sawa. The difference, this is a really good question. I think we've not addressed this. What is the difference between a trust fund and a trust?
So, a trust fund, which is what we call a cash management trust, only deals with cash and cash equivalents. A family trust, on the other side, because we have other assets like land,
Mm.
we have the stock market bonds. So if you wanted now to also make sure that these do not go through the courts, because the principle on how it works is the same, now we have to have a family trust. So let me give an example. I have both. I have both a cash management trust and a family trust. So the cash management trust is to handle my money and my life insurance process, because I have quite a number of policies and I do not want to think that these policies could be mishandled. So that one I would want now the trustee, well, who do we call it? The corporate trustee to handle it. And there's a way I've structured it. And then I have a family trust to be able to handle all my other assets. Currently, I have a business, right? There is now assets like land, there's my bonds. So those ones now I've had to transfer ownership from myself to this trust. Yeah. So that means that the trust is the new owner. I am currently just the settler and I'm also the beneficiary of my trust. It's just that now I'm no longer the owner, but at least when something happens to me, my children never have to go through the court. So the principle is the same. It's just now this one handles all the other assets. This one handles just cash. That's why it's easy to set up and more affordable to set up. This one, like, there's no setup fee. You just put 5,000 shillings, which is credited into the trust fund account. This one, I had to spend like about 200,000 to set up.
Yeah.
But and so I started first of all with my life cover and the cash management trust. Then with time, that's when I put my money aside and eventually had a family trust to take care of my other investments.
Yeah, and that one is usually handled by a lawyer who handles those kinds of things. So even the costing will depend on the lawyer you're dealing with, the kind of assets you're dealing with, and stuff like that. Mnyendo, there's someone who's asking, for the endowment, okay, for the education policies, when you see like there are these education policies that will pay you maybe in year, let's say it's a 15-year policy, they'll pay you in year 3, maybe in year 6. So if you've been getting the payouts, do you still get the sum assured at the very end?
So it depends on the plan. Like it's different for different policies. So there's the ones which do partial payouts and then they pay a sum assured at the end. And there's the ones everything is just now the partial payout. So it's good to see how yours has been structured. But majority of them it's the partial payouts and then one final maturity amount, which is usually the sum assured.
Okay. Can a settler have one or two or more trust fund accounts?
So we have people who have separate for separate kids. So people have different philosophies. There's the ones. So for me, because all my children are very young, I've just put them in one trust fund account for ease of administration. But for some who their children are a bit older, they just don't want the funds to mix because when one grows, they just want like for them to have access at a certain age. So they've decided to just have separate funds. So you can have separate trust funds. Just the way you can have different money market fund accounts, you can have different trust fund accounts. And yeah, as a settler.
Awesome. Awesome. Guys, if you feel like there's a question I've skipped because we are now wrapping up, please just copy paste it in the chat box very, very quickly because we don't want to leave anyone else out, but we are now wrapping up. Mnyendo, please, I don't know if you're gonna send us the link in the group. We need to know how you can assist us in setting up this because I know, like for mine, you helped me set up the whole process. I don't even know what happened. Yeah, so I don't know. I just know you handled it. So for anyone who is interested in taking up like well advised like life insurance, setting up the trust fund, Risk Africa has helped me with that. So I hope you could probably
yeah, there in the chat.
yeah, just let us know how you can assist us to set up some of this that we've discussed today. As you do that, I can also answer Anne is asking, as a 23-year-old, can I have a trust fund for another goal that is not education or my kids? Absolutely. Like you are actually the one, as you've had, you can even set up the trust fund, you yourself as the beneficiary for the trust fund or specify whatever. I've seen people setting up trust funds for charities they support, maybe even a church you support. You can literally just leave whatever instructions you want there. So that's that.
I've sent for life cover. Let me send for trust fund setup.
Shiro is asking, is the trust fund paid for annually or monthly? It is self-paced. It's like how you fund your money market fund. You can fund it at whatever time, 3 times a month, once a year. When you get a big bonus or a lump sum, it's just up to you. You're not like restricted. This is not forced savings like some of the policies. So it is generally self-paced. Okay.
So I've shared links for the life cover and trust fund. So the best combo is actually both of them together, just as Susan said. So you see now when you think of education policy, you know that it's taking care of, like the savings element and the protection part. But if you wanted to build your own, so you have your own standalone life cover and you have your own trust fund and you connect them by making the trust fund the beneficiary of a life cover so that now you have one proper structure.
Awesome. All right. Evelyn is asking, can one use a trust fund to save for pension and eventually structure it as an annuity? Maybe you can.
So I'm thinking the question should be, because you see trust fund and pension are two separate products. So maybe I think what she's trying to say is, can one use a trust fund to save for retirement and eventually structure it as an annuity? You could do that. Yeah. Because what's like, what do you call it? So as I said, everything is goal based. And if you want to have the trust fund as a way of accumulating your investments, for retirement, you could do that. And then when it's a lump sum, you can transfer it to an annuity and then you receive the money per month for the rest of your life. Yeah, you could.
Yeah.
Yeah.
However, let me ask you, Mnyendo, is that something you would recommend given that?
So what I usually see, I believe if it's pension, just because of the tax benefit.
Pension. Yeah, there's a tax benefit.
So there's the tax. So if you wanted to save, you could save it. You could save. But what I would recommend, if you want to plan for retirement, just use pension because of the additional tax benefit. But yeah, it's just the way that sometimes people ask, what can I use my money market fund to save up for retirement?
Yeah. Regina, do you lose anything if you stop saving at some point? No, your money stays there. It keeps earning interest. Remember, we've just said that this is almost like your typical money market fund, only that it now has that legal layer of protection where you're like, okay, I've left instructions in case, like the difference between this and a money market fund is that a money market fund would have to go to court for your beneficiaries to be able to access it. And the trust fund wouldn't be. So guys, I hope you guys are understanding that it's not either or. It's like you can't use one to replace the other. It's everything has its own everything has its own purpose in your portfolio. Your money market funds have a role to play. Your life insurance has a role to play. The trust fund, remember I told you guys the easiest way to understand the trust fund is this is the pot that will receive the cash that I do not want to go through probate for any reason or whatsoever. It's like it's by there I keep telling people that the trust fund is like the final nail on the head. It's like the highest level of protection you can actually put in place. Because you see, even wills sometimes are challenged in court. Someone can come and argue that when you are writing this will, you are not of sound mind or you are coerced or whatever. But like a trust fund is ironclad. No one is coming to challenge that. The instructions are clear. The trustee knows what to do. And it's just that. So understand the difference of, all these things have a role to play. Are there tax benefits of a trust fund, Mnindo?
So with the trust fund, because the underlying investment is now the money market funds and all of this, so just the way they are taxed at source.
Yeah.
So usually now the tax benefit comes now in the actual family trust, like now when you're transferring your piece of land from your name to now the family trust, you don't have to pay things like stamp duty. And there's the way now some of these things are structured in a way that you minimize tax, but not for cash management trusts.
Yeah. All right. Gosh, guys, it's been amazing. It's already almost 10 p.m. We've been here at
Hours.
Mnindo Aki, I cannot begin to say how much I appreciate all the information that you've given us. It's very, very rare to find an agent of your caliber who's willing to actually take us through the ins and outs of, these policies. Earlier on, there was someone in the group who was asking, why would an agent sell this? And, I shared in the group and I said, some of these policies have, commissions as high as even 20% or more. So this is just to say we really appreciate your willingness to actually be able to, to be able to share this information with us. I think I keep telling people I'm a great, great beneficiary. Since I became your friend, you
Yeah.
picked me up pretty much, like my pension, my life insurance.
The trust fund.
You
Like
know,
literally all the parts of your life from before the baby.
and now after the baby. And you guys would be, by the way, let me give you your flowers. Guys, when I gave birth to my son, the first person who actually gifted me was Mnindo, and she actually gifted me a trust fund. Like for me, I'll never get over that. The fact that you funded it and you are like, Susan, this is funded, please fill in this paperwork. That's what I'm gifted you. So you've really opened up our minds. So guys, please make sure to reach out to Mnindo. She's already shared the forms. In case you need any assistance with your financial planning on this other end, the budgeting bit of it, the investments bit of it, I'm ready and willing to take you guys through the same. So I'm also going to be attaching a link to my website so that you can check out some of the services that we offer in terms of financial planning and investment planning for the same. But thank you so much for even staying. 3 hours on a weekday. That is great, great sacrifice. So thank you so much for joining us. And I think without further ado, Mnindo, I'm just going to ask you to give us your parting shot and then I'll end the webinar.
Awesome. Thank you so much for staying until this end. If there's something that I'm passionate about is families and just creating structure, because we have seen the way lack of structure can create so much chaos in not only our lives, but our families' lives. So it's so important, even now as you're making these plans, to be very, very careful with your money. And as I'd mentioned, please respect your money. Just don't put money and you don't even understand what it is that you are getting in return, right? And at the end of the day, also, as I said, structure is also as critical. How this money is going to flow from yourself to the people who it is that you care for. Because what's the point of money if it's not to benefit the people we care about and ourselves, right? So information is power, and thank you for being here to just listen. Because if there's one thing that I've been trying to now at least get the point across, is insurance is not a bad thing. Insurance done badly, and if it's not understood, that's when it's a bad thing. Just like any tool, right? A tool can be used for good, a tool can be used for bad. But if you know how to use the tool and it's goal specific, it can really, really work out. And we have seen how it has come through the last number of years being in this business. We have seen how chaos have been completely minimized, especially now for us. Majority of us are what we call first generational wealth builders. So we have to be the blueprint. We have to be the ones who are changing the path for our families' lives. So get educated. Education is power. And yes, we are very happy to walk along this journey with you. So Susan will definitely help you with your investment. Make that money, multiply that money for the future generations. We'll help you with the protection and preservation. So in case, please don't forget to follow us at Le Risk Africa. We share so much there. And we also have a YouTube channel, Insurance Unfiltered by Le Risk Africa. So please share, just check out there, because that's a place where we give a lot of the information. So with that, have a lovely evening, and I wish you all the blessings in the world.
Thank you, Mnindo. Thank you, ladies and gentlemen. It's been a pleasure. Have a good night. This has been so good.